drive. Join the ride, music loud, tech and tunes, we so proud. Show your skulls in the crowd, come on, shout it out now. Join the ride, music loud, tech and tunes, we so proud. Show your skulls in the crowd, come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Tech and tune, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Come on! Come on! Come on, shout it out now! This is Sugar Skull Show. We got lots of music, technology, and more. Come on! Come on! Sugar Skull Show, here we go. Music, tech, and much to flow. Come on, dance, let it show. Energy high, feel the glow. Lights flash, beat gotta catch. Groove to the sound, make it last. Tech magic all around. Feel the vibe, feel the sound. Join the ride, music loud. Tech and tunes, we so proud. Show the skulls in the crowd. Come on, shout it out now. Gadgets, gadgets, lights so bright. Rhythm takes us through the night. Feel the pulse of the scene. Sugar skulls, living a dream. Come on! Step by step, we won't stop. Feel the beat, make it pop. Tech and tunes, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Tech and tunes, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Tech and tunes, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Come on! Come on! Come on, shout it out now! This is Sugar Skull Show. We got lots of music, technology, and more. Come on! stop. Feel the beat, make it pop. Taking tunes so alive. Sugar skulls, keep the drive. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Taking tunes, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Taking tunes, we so.
Hi ho, hi ho, hi ho, it's off to work we go. Yeah, here we go again. Looking at them stocks, baby. Them stocks. Look at that, dopey go right down the toilet. Play a little song I wrote. Well, I co-wrote it anyways. I mean. Remember, kids, no matter how many times you play a song, you can still mess it up. Much better. Dopey Stuck is going down. If you ever had McDonald's, if you ever had McDonald's. some mustard, but I don't. McDonald's makes the best French fries in town. 'Cause I don't think they're really French fries. I think they might be some kind of plastic that makes you cholesterol go high. That's enough of that. Let's get back to business. Let's see. We've got home screen. 46 minutes to opening. Sure don't have meetings. Good grief. I asked the team this morning. I asked the team this morning, and they said they're not using these. All right. I'm going to leave you to the Schwabbies. Turn on the Schwabby.
Actually, if you look at the equal-weighted S&P, the equal-weighted S&P is certainly outperforming, right? It's outperforming the S&P. The Russell's up about 11%. Even the transport's up to date. Now, when you think about high oil prices, you think the transport should be getting hit. But the transports are outperforming at the moment, and that tells you that the economy is strong because we're transporting goods, we're transporting stuff. And so that's the positive sign. So I think that, once we get through the next couple of weeks and get through earnings, I think you're going to see the market broadening out again. I think the focus this week has clearly been on tech because it's a big week for tech. And also tech had gotten really dislocated over the past month. And so when people started to feel more comfortable, they looked for opportunities. Where did they go? They went to tech because it was so oversold.
Yeah, it was very much so. But it will be interesting to see once the market opens how it treats Microsoft, for instance, because it made a recovery, but and
I think Microsoft was down a tiny bit in the pre-market. Meta was getting, Meta was getting slapped
because they're not giving any visibility on what they're spending on.
No, he's just spending like there's no tomorrow, right? And so at some point the market says, okay, you got to stop, right?
Or give us some indication of what this is for. Like, but, for instance, Alphabet, Google's clearly laying out what their spending is.
Amazon.
And they're taking market share away. Gemini's taking market share away from ChatGPT.
Right.
Quick thought from you on, what you're watching today. Is it about big tech leadership?
Well, so today I'm going to watch the PCE and the GDP because that's going to be more about the economy. But I want to see how the market treats those four big techs. And remember, you have Apple coming out after the bell tonight, but you also have a cross-section of earnings today. You've got Hyatt, you've got a range of sectors that are reporting. You've got Pharma, which came out. Lilly just crushed it, right? You got Merck coming out. So you've got MasterCard that's coming out, right? You've got other energy names that are coming out. So you got a cross-section of earnings today, so it's going to be interesting. Yesterday we had 90 reports. 80 of those companies that reported beat. So that's a very, very good statistic, and that speaks to the strength of the economy.
GDP 2%, so still a little less than forecast, but growth compared to what it was before. And we know this is the first read.
Yeah, did that just come out?
It came out minutes ago.
Okay, so I didn't see it yet. But yeah, while it's a little bit less, it's better than it was, but it's and it's still positive. So that's a positive.
Yeah, and then business spending was good there. So
that's
a positive.
And that speaks to what CEOs are thinking about the economy.
Yeah, and that the AI data center spending is happening. There's growth there, at least when it comes, especially for Alphabet, Google, Amazon. And then they're becoming Amazon's becoming like a chip company too. Not NVIDIA, but any final thoughts you want to leave us with, Kenny?
No, I just think, look, I think you have to you have to recognize that there is noise out there and there is some, potential for disruption. But if you maintain kind of a fully diversified, large mega cap portfolio, I think you just ride out this storm and take advantage of the opportunities that are created because of the chaos.
Okay, all right, thank you, Kenny. Appreciate it.
It's always a pleasure. I love being here with you.
Same. That's Kenny Pokhari. He is the Chief Market Strategist of Sladestone Wealth and partner over there. Coming up, time for Options Corner. We'll chart and trade Apple ahead of its earnings. Those come after the close. Continuing our eye on big tech. Morning Movers will be right back.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need, all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab as everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
We're back on Morning Movers. Apple set to report earnings after the close today. The Street's expecting earnings per share of $1.92 on an adjusted basis on revenue of nearly $110 billion. Investors will be watching closely for the company's iPhone sales and updates on its integration of AI into its products. Time now for Options Corner. Joining us to take a deeper look at the chart, it's Rick Ducat, lead market technician. All right, Rick, let's get into this chart. What trends do you notice for Apple?
Yes, good morning. And as you said, Apple kind of a curious laggard in this AI field series, kind of not really generally considered being up to par with some of the competition here. But we can see that Apple more or less on pace with the S&P 500 being left behind by the tech sector as a whole, up 51.6% versus Apple up 27% here. So if we do look at how Apple stacks up against its other peers in the Mag 7, kind of near the lower end of the group here, Apple down here in this teal color, being far outpaced by the likes of NVIDIA and Google Alphabet. So when we do look at Apple more specifically too, we can see that the area near 246 down here was a notable low point. It represented the high before we had a gap up, and then repeatedly was tested and most recently held firm in mid-March here. From there we had a upward sloping trend line that materialized here. We have since drifted beyond it, despite breaking out as well from this downward sloping trend line that began with the all-time highs. So now we find ourselves kind of in something of a no man's land here. 277 to the upside, representing a notable resistance area, old highs, subsequent lows, and then repeated highs there as well. So that would be one area to watch for potential resistance going forward. Our moving averages show that we are between our short-term 5-day and our monthly 21-day EMAs between about 270 to 265. Those could be some short-term boundaries to watch out for. A little bit of decline decline in momentum as well. Pretty common as you head into earnings. Often this is what the case that you see with stocks in this situation. Volume profile shows that we have two pretty clear nodes close to our current activity. The bigger one is where we are now, which contains our point of control near about 271. Meanwhile, another node that's almost as large comes in here between about 255 to 260 or so. So that could be a supportive area if earnings disappoint.
Okay. All right. Thank you, Rick. Appreciate that. Now to take us through an example trade, we've got Tom White, co-host of Fast Market and senior options contributor. Tom, this one is solo today. It's a microscope on Apple with its earnings due after the bell. What's the approach you would take for an example trade?
Yeah, the forgotten one out of the Mag 7 as far as maybe headlines recently, but they're not spending as much money. CapEx is really low compared to those competitors in this space as they're not spending on this AI build out as much as the others. So the option market's pricing in about a plus or minus 3.5% move. So that's muted also, right? Implied volatility levels aren't as elevated as some of those other names that reported last night. So I looked at a strategy with the stock basically flat on the year and up 27% from a year ago levels. It's underperformed. So I looked at a strategy that takes advantage of dispersion between implied volatility levels between the option series. We looked at a bullish call diagonal here. If you think the stock's going to go higher, this takes advantage of it. Went out to the May 15th monthly option, so 15 days to expiration. We're going to buy the slightly in the money 270 strike call. Stock looks like it's going to open up here about 271 this morning. So we're going to buy the May 15th 270 call, and then against it, we're going to sell the May 1st weekly options, the 282.5 strike call. That's where you want the stock to go to, which is about that one standard deviation that the option market's pricing in on a one-day move. So $12 wide, $12.50 wide bullish call diagonal here. You're going to pay roughly about $620 debit if the stock opens up here about 271. So that's going to be your risk, $620 per spread. Anything above about the break even is going to be about 273. So anything above those levels is going to be potential profitability on this. But look what you're paying on a $12.50 wide a call diagonal that's bullish to the upside. You're paying about half the width of it. So that tells you right there there's that volatility dispersion. You're buying about a 34% implied volatility in the May 15th 270 call on aggregate, selling about a 78% implied volatility in that near-term May 1st weekly on the 282.5 strike call. So that vol dispersion lowers the price entry point. You do need to move to the upside, but that break even of about 273, that's less than 1% above the current share price. So looking for some upside exposure here in Apple, taking advantage of those IV levels.
All right. Thank you, Tom. Appreciate that example trade there. Thank you so much for joining us today on Morning Movers. I'm Diane King Hall. Download the Schwab Network app. It's available in the App Store and tune in 24/7 on schwabnetwork.com. Stay with us. You've got Opening Bell with Nicole Petalides up next.
So what is unique about Schwab Coaching is the community.
There's a lot of energy, like-minded people are learning with you.
You can just see and feel all the excitement around getting to learn a new topic.
Some of you want to get everything face-to-face with you and 400 or 500 of your closest friends.
Some clients like to be in the privacy of their own home on an online workshop, but still having that live interaction with the coach.
As I'm talking, questions are coming in from that live audience, and they help me fill in those gaps as an educator.
People learn differently, but all those ways we actually teach it all come back to the point of making a difference and helping you make progress.
And so that means not just giving you theory, it means giving you the practical implementation using our platforms.
So we want it to be fun, we want it to be informative, and most of all, we want you to walk away with a skill set and independently be successful in achieving your goals.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute. With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Good morning. Happy Thursday. Welcome to Opening Bell on the Schwab Network. I'm Alex Coffey in for Nicole Petalides. Let's take a quick look at where futures indicate the market may open. S&P 500 scorching hot here, up 36 points in the pre-market. That's 0.5%. NASDAQ 100 on the heels of a bunch of big tech earnings yesterday afternoon is up 200 points on the nose. Russell 2000 up about 3.5 points, and the Dow up 300. Taking a look at some of the other products on our radar, see a little bit of a move lower in Treasury yields, particularly the 10-year. See the U.S. dollar following suit, down about 0.5%. Bitcoin is higher following risk assets, leading risk assets up 1.14%. You see volatility index is in a little bit. VIX in about a point, 1775. Gold also rallying up almost $100, up 2%. And crude oil, which has been a big part of the discussion, crude oil is in about $2 WTI in the June month. July Brent in about 165, about 1.5%. So crude oil still a big part of the discussion, a big part of the story. And with that, we'll welcome in our first guest. We welcome in Kevin Hinks, the co-host of Fast Market. Kevin, of course, a longtime trader as well, and he's joining us live from the SIBO. Mr. Hinks, we got a futures market that's rallying. I think we've both been saying pretty much all week long, circle Wednesday afternoon, those mega cap tech earnings. We're going to have a lot to say about it, and boy, did they. Not all higher, but the balance of the group certainly sending things higher today.
Yeah, exactly. You know, the market feels good about the earnings, but Meta, you know, is still increasing CapEx spending. So remember, there's still a negative reaction to CapEx spending. And so responsible CapEx spending with big numbers is being rewarded. Irresponsible CapEx spending or too much without clear justification is not being rewarded, Alex. But a big day. The markets are going to move. The markets are still feeling good. You've got the E-minis up over 0.5%. The NASDAQ up 0.75%. The economic data that we got at 7:30, really a data dump of top-tier economic data, didn't shake the markets at all. They dipped slightly, but they're basically unchanged from where they were. I'll go through the data rapid fire for you, Alex, and then you can decide which one you want to spend more time on. First one, jobless claims. Incredibly strong first-time filers for unemployment insurance at 189,000. First look at first quarter GDP, 2%. That was a tenth less than expected. But remember, it ended the fourth quarter GDP with only up 0.5. So nice jump up to 2%. Personal consumption expenditures, 1.6%. That's a tenth better than expected. Then personal income and outlays. Personal income, way better than expected, up 0.6. Personal consumption expenditures there, up 0.9. That's in line. Now, the inflation data that we get from PCE month over month, up 0.7 and 3.5% year over year. That is in line with expectations, but as you know, because of crude oil, a big jump there. The core, up 0.3, that's in line with expectations, and 3.2%, 0.2 higher, but in line with expectations, Alex. So a lot of economic data, none of it really scared the market too much, and the low fire economy keeps trucking on, Alex.
Yeah, GDP a little bit lighter, maybe something to watch as we get those adjustments in time. You mentioned initial jobless claims. They're really not a story until they are, and so we watch them, but we really haven't had much to say about it. So that leaves the one left, and it's the one you ended on, Kevin, which of course is the holistic personal income and outlays report, which contains inflation information, it contains spending information. And I always like to look at just the real personal spending number, Kev, which sort of takes both of them into account. Takes that expenditures, it adjusts for the inflation number, and we have a real personal spending that was up 0.2%. To me, that's still an economy that's growing. That's still an economy that's spending and consuming, and we know how important that is to things like GDP. So, Kev, what is your thought as you kind of look at that report? There's a thought, I guess, that tax refunds had to do with the income side, but when you look at, sure, a jump in inflation, but also a pretty nice jump in expenditures as well. Is there anything alarming there? Draws extra attention or standing out to you?
Well, I think the PCE data came in, acknowledging that we have higher crude oil prices, acknowledging in the core that things are starting to drift a little higher from 3% year over year to 3.2%. It's not great, right? We'd like to have that number coming down, but with tariffs, with crude oil, there's a lot of reasons why the core PCE, which is what the Fed watches, has firmed up and isn't moving back down. We need a lot of these disruptions like tariffs, like higher crude oil prices to kind of subside. Now, that being said, despite we know that there's disruptions in the crude oil market, not necessarily supplies for the U.S., which is well supplied with crude oil, but we can't argue with the higher prices. Even though they're down this morning, I wonder what the crude oil market knows that the headlines don't know, because the rhetoric between Iran and the U.S. seems to actually be going up, but crude oil prices are lower. Maybe it's the precursor for some type of negotiation behind the scenes. I don't know, but I'm a little surprised that crude oil prices are actually lower this morning. Now, that being said, with the disruptions, we cannot argue that the large percentage of the economic data coming out are stronger and showing a strong U.S. economy, not only in jobs, not only in wages, but how about overall consumer spending and the health of the U.S. consumer. So the good news is for the U.S. economy and corporate earnings, all strong and doing extremely well. The problem, we have disruptions, right? With slightly higher prices and complete disruptions in the crude oil market, Alex.
Kev, we have June Brent up there on the screen. June Brent made a new high for the contract last night. It hit 126. Now, granted, it is back down now $4, just below 114, but I'm with you. I mean, the oil markets are singing a different tune than they were just 12 hours ago, but also different than maybe what some of the headlines suggest. So we'll see if maybe some good news or positive updates are on the horizon, or if this is just typical end of contract type of things, as I believe it's close to the end of sort of trading before real settlement, physical settlement starts coming into play for that. But I want to leave you with FOMC. There wasn't a lot of market-moving stuff in it, Kev, but there was some news that was certainly made from the press conference.
Yeah, exactly right. I thought Jerome Powell really, other than saying he's staying on, which, by the way, full disclosure, I don't blame him for staying on until this IG is resolved, the investigation is resolved. I would stay there and defend my turf as well. And so he still has 2 years that he can stay, but he'll certainly give up the gavel as Fed chair by May 15th. Kevin Warsh has to be confirmed by the complete Senate. That'll happen sometime in the next 10 days. He'll take the gavel on May 15th. But I thought Jerome Powell, all things considered, in his tenure, he did a lot of things right, like bring us through COVID and get us here. He did a couple things wrong, right? He'll get tagged with transitory, though I'll go on record. Transitory, that statement was not his fault, because after he said that, the Biden administration spent $4.8 trillion. That's why inflation went up, and inflation wasn't transitory. So all that being said, Jerome Powell's legacy, which he's staying on to fortify and make sure it cleans up, will still be a fairly good one despite a contentious relationship with the president, Alex.
Yeah, some potentially performative dissents, which I think makes things interesting. Rather than just kind of arguing in the meeting and then agreeing at the end, they're going to start maybe arguing in the actual statement. I think that actually could be good. And I'm with you on transitory. I won't even say it's necessarily the spending or not. I think the FOMC just operates on a different timetable than what we as consumers and the public interpreted the message as. If they're thinking 2, 3, 4 years, maybe it was transitory. But we're thinking, hey, last week it was less expensive. It's still getting more expensive. I don't like that term. So we'll see where it goes from here, Kev. Appreciate the update as always. Always a pleasure. Mr. Hanks joined us from the SIBO. So we say goodbye to one Kevin. We welcome in the next, and that's Mr. Kevin Green, senior markets correspondent, back at home. KG, good to see you this week. Let's talk some of these big tech earnings. We thought they were going to be important. They were. Mixed in terms of reaction, but strength in the right places. Alphabet really put this market on its back.
I would agree with you, and it's also giving fuel to some of the other themes in this market when you're looking at the semiconductors kind of getting a bid after these announcements from yesterday, as well as some of the power names as well. We kind of talked about one of those names yesterday, but Google Alphabet actually did beat and exceed the street's expectations, and rightfully so. You are seeing the shares higher here. Revenue came in at $109.9 billion. Street was looking for $107.2 billion, so about a 22% increase on a year-over-year basis. Now, the EPS actually came in at $5.11, but it's not really comparable to the adjusted EPS, which was sitting at $2.64. They did have some one-time items that did hit the market here. Now, Google Cloud revenue increased by 63% on a year-over-year basis. The Enterprise AI Solutions Group saw 800% increase in Q1 and is now the primary growth driver for Google Cloud here. And they continue to see enterprise spending ramping up on a quarter-over-quarter basis. Now, Sundar Pichai talked about compute being constrained in the near term. That's why they are raising their CapEx spend by about $5 billion. But they are also talking about the return on that investment over the next 2 years and how they are going to be able to drive revenue. So they have been able to not only take market share from others within this space. You can see that within the cloud growth. They are spending, but they're spending in the right areas. It seems like we are seeing a little bit of a return on investment from the CapEx spend over the last year and a half, 2 years or so. And they are going to start delivering some of the TPUs directly to select customers here for data centers over the coming months and years. So this was actually a really strong report, really good commentary when it came to the conference call. And this one has been an outperformer. Obviously, the fundamentals are now backing up some of the price action that we've seen over the last 2 months.
Kev, I'm going to lump Amazon and Microsoft together. I know they're very different, but those two seem to be more volatile after hours. Meta was straight down. Alphabet was pretty much straight up. But it didn't seem like the market was totally sure what to do with either Microsoft or Amazon. It listened to the calls. It kind of changed its tune. Microsoft's been up and down, several times. It's down a little bit right now. What stood out to you about those two?
Yeah, I would say for AWS and Amazon here, their AWS growth actually increased by 28% on a year-over-year basis. So it did beat the street's expectations. It was the fastest growth that the company has seen for AWS revenue in over 3 years. And they are now generating around $15 billion in annualized revenue because of that particular business. Now, the online stores, which is still a component and a really big component when it comes to revenue just in general, that did increase by 12% on a year-over-year basis. Advertising came up around 24% increase on a year-over-year basis. It did beat the street's expectations, but it does appear that there might be a little bit of caution around advertising spend from not only on the Amazon platform, but also Meta and other pockets of the market here. So I think they actually had a really decent report. Andy Jassy talking about that CapEx spend. They say that most of the spending from 2026 is going to be monetized over 2027 and 2028. I thought that was actually a good comment there. And when you're kind of looking at Microsoft, I think the Azure growth, which was around 40%, seemed like that's what they're guiding for moving forward. That is a positive for them, but margins are being squeezed here a little bit in the near term. So once again, a little bit of a blend or a mix when it comes to that report. But all in all, we did not get any bombshells that really kind of created or suggested that the AI trade or the narrative is starting to shift, especially in the software front. And it looks like everything's kind of holding up for now.
All right, and then we'll end quick here on Meta. I was most interested personally in this one, just simply because I had a hunch they were going to say they were spending even more money. They did say that, and not because of that, but I wanted to see what does the market do with that. Market didn't love it. So is that alarming for these hyperscalers going forward, that CapEx ramping is not being rewarded? Or do you just shift your focus, like you said, to maybe some of the power names or some of the data center players that are certainly loving that Meta decides to spend at least $10 more billion?
I think the market wants to hear why you are spending the money and when you are going to see a return on investment. If you listen to Alphabet, Google, they're telling you how much they're spending, where they are spending. They even broke it down to servers and other products. Meta is more of a situation where they talk about the CapEx spend, but they don't really give you any type of insight as to where that is actually going. That's a concern. So that was one issue to the downside. Operating margins also kind of holding up, at least for now. The other issue when it came to Meta, though, is the daily active people. That came in at 3.56 billion for the quarter. So it's up 4% on a year-over-year basis, but down 5% on a quarter-over-quarter basis, and it did miss the street's expectations. You have lower daily active people on your site. Obviously, that means lower ads, or the amount of ads that you show is not going to be as much, which obviously has an impact on top-line growth. So this seems like it's not only the guidance when it comes to CapEx, the vagueness when it comes to where they are spending that money, but also their primary business seems like it had a small deceleration in the Q1 quarter.
It's under a lot of pressure here, KG. We'll see if it can stem the bleeding a little bit as the day rolls on, but appreciate the setup. Good review of four of the biggest earnings that we're going to get this earnings season. Coming up, we're going to be joined by a portfolio manager. We're going to discuss that AI trade and maybe where the next areas of opportunity exist within that realm. You won't want to miss it. We'll get you set up for the trading day right after this.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Hi, I'm Alex.
I'm Jane.
And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Welcome back to Opening Bell. I'm Alex Coffey in for Nicole Petalides. Let's get you set up for the trading day and discuss the new frontiers of the AI trade with our next guest. That's Nitin Sacheti of Papyrus Capital. He's a portfolio manager for Papyrus. Nitin, good morning to you. Happy Thursday. Let's talk the AI trade. We just talked all these hyperscalers and how much money they're spending, but they're spending it on aspects of this build out. Where do you and your firm see those opportunities in this maybe next leg of the AI trade?
Yeah, thanks for having me, Alex. Yeah, I mean, I think, we've essentially been, through this AI trade for the last, 18 to 24 months now, and I think a lot is already priced in. You look at where hard disk drives, DRAM, NAND flash, where, memory generally is trading. You look at some of the data center builders, some of the, power-related names, and they're up pretty significantly. And so we're, looking for that next leg, right? Where is the transition in spending going? So one area where we're seeing that is in co-packaged optics. So the way to think about that is, historically, over the last 10 to 15 years, when you think about residential broadband, we had DSL connections on copper, and that was all replaced by fiber because fiber, could get higher throughputs, higher bandwidth, and it's not electrified. So that's one of the areas we're seeing in the data center is, the shift from copper to fiber. And so the nice thing for us is being ahead of a trade like that, or sort of in the, the fifth, sixth inning of a trade like that, helps us, buy something that the market hasn't already seen. So we're in sort of a number of, co-packaged optic names, and the other piece of that trade is really abroad. So a lot of the U.S. names have really, again, rallied pretty significantly. So we're looking at Europe, we're looking at, at Asia, and Japan specifically, and then we're also involved in the wafer trade. So wafers are used to make semiconductor chips, and there was an inventory build of wafers over the last several years, and so that inventory is being worked down. And so as that inventory gets worked down, we're just going to need more wafers for more chips, and those businesses really haven't seen, again, their stocks rally the way you have in so many other areas of the capex, AI capex trade. So those are kind of some of the areas where we're looking at the next leg of the trade, just so we can kind of protect our downside, buy these stocks at great valuations, and still participate in the upside.
Exploring that a little bit further, Nitin, if you don't mind. You don't have to give away the secret sauce, of course, here, but many of our viewers are self-directed investors. They're building portfolios. They want to take the professional approach. You mentioned some of the just enormous performance gains in some of these stocks within this, kind of other aspects of it, whether it's memory, whether it's power. When you see a stock in some cases go 10x plus in a portfolio, if you started with a relatively small allocation, it suddenly becomes a much more concentrated piece of a portfolio. As a professional, how do you and your team kind of approach that when suddenly what was something small and you hoped this would happen, it does happen, and now you have a whole lot more exposure to one or two names?
So great question. So we're doing that in two ways. One, we're trimming, right? There's nothing wrong with taking some profits. Obviously, you have to take taxes into account, but so we're trimming. And then we're hedging on top of that, right? And so how are we hedging? We're hedging in shorts in some of the, more elevated operators that we think were the, earlier stage trades here that, as some of the data center spending potentially subsides by 27, 28, 29, those stocks might be the first to fall. So I think that's one way. And then the second way is in options. We're, overlaying the longs with, puts in businesses that we think, again, are overextended too. So I think those are the two ways we sort of balance the risk reward, to your point.
And when building these portfolios, I would imagine not all of the portfolio is in these sort of asymmetric positions. I'm sure you also build it with things that you have confidence that are going to be sort of consistent and sort of building around that. What are the kind of names that you're seeing here, whether it's in different sectors or different parts of the market that maybe aren't getting enough attention? You mentioned Japan, for example. What are some other areas that you and your team are looking at beyond maybe just these AI infrastructure plays?
Well, I think tangentially, sticking with AI tangentially, there's a lot of other beneficiaries that, again, the benefit might be a year or two out that people aren't really thinking about right now. And one of those ways is really midstream pipelines in the Permian Basin. If you think about all of these data centers that are being built in Texas, right, they're all being built. You think about GEV, Siemens Energy that are backlogged for the next several years on gas turbines. A lot of it is going into these data centers behind the meter, right? You build a data center in West Texas, you build a gas turbine to kind of handle your power. But where is that gas coming from? It's coming from, you know, the Permian Basin, where prices are very low, especially compared to, you know, natural gas prices we see in Europe and, you know, Asia right now, especially with sort of the Ukraine and Iran. And so I think that's one area where we're buying, again, businesses generating real free cash flow that will take some of that gas in the Permian and deliver it to these data centers in the next couple years.
Nitin, as sort of a final thought and kind of tying this all together, we were discussing Meta, for example, in the previous segment with our last guest. And we were talking about how they're one of the names that's sort of the face of this giant CapEx for this build out. But it's no longer, in the case of Meta, for example, being rewarded. You know, what do you believe that these hyperscalers or other companies that are making tremendous investment in kind of the pushing of AI forward need to show or can show to justify it?
I think so. The way I would answer that is by saying, look at the last 3 to 4 months of the AI trade. And I think a lot of that is a function of Anthropic Claude. And I think what they got right is really the orchestration layer. And so that orchestration layer is essentially taking, you know, all of this raw compute power from the LLMs and the data centers and, you know, using that appropriately, right? Generating that ROI that you mentioned earlier. And I think it's the same thing with the sort of CapEx spend for the hyperscalers. And you see that, you know, Google is sort of the only large cap that we own. And really because I think they're getting sort of each of the layers correct. And so, again, it's the same thing. Over time, we need to see that orchestration layer is done properly to generate that ROI that you're obviously seeing Anthropic get. And, you know, that will sort of justify the CapEx spend.
Nitin, I wish you the best rest of the day you can have. I really appreciate you taking the time and joining us here on this Thursday morning. It was a great conversation and looking forward to continuing it sometime in the future. Portfolio manager for Papyrus Capitals. We say goodbye to Nitin. We welcome in our next guest. That's Sam Vadas joining us here, of course, the host of Morning Trade Live and Market on Close to help us set up things here into the bell. Sam, we had quite a bit happening pre-market here from data in the U.S., but we also got some stuff happening overseas, central bank-wise as well. What stood out to you?
Yeah, a pretty macro kind of heavy day everywhere from here to the US, over to London, and also the ECB as well out in Europe. So we had a pretty busy sort of morning on central bank action. We had the ECB and the BOE both holding rates as widely expected. Obviously, they are monitoring the situation with respect to the upside risks to inflation and the downside risks to growth in their respective regions. The ECB saying that some of those headwinds had intensified. So they're going to go meeting by meeting now and really just go data dependent as the months roll on, because they are obviously just trying to monitor the impact from the Iran war on their economy, because for now they believe it looks resilient. But look, if higher energy prices do stay elevated over the summer, a lot of economists I've been talking to as far as their modeling say that that could potentially become quite a headwind, particularly for Europe, which is energy dependent. Obviously, we know the situation here in the US is somewhat different in places like China as well. So we got those two decisions. The BOE standing pat as well, as I mentioned, out in London this morning. So I'm watching the FX markets this morning. Obviously, we've got the Dixie coming off a bit. As we can see here, the US dollar index at 98.37. We are seeing some strength coming through for the euro. We are seeing some strength coming through for GBP as well. Taking a look at the dollar-yen cross this morning, this is really important as well, because we have had some jawboning out of Tokyo as well from Katayama, the finance minister out there, because we did approach that 160. In fact, we did cross it. Dollar yen 160. That's very politically and economically sensitive for the Japanese. So we did see some verbal messaging coming out of the finance minister there, giving a final warning. The timing for bold steps is nearing. So we saw a 3% strengthening in JPY just this morning. So watching the US dollar yen as well today. So keep an eye on that. But other than that, of course, keeping an eye on the initial jobless claims that we got. People say this is the lowest since the 60s. I mean, incredible numbers. We've got the GDP at 2%. Things are looking somewhat resilient. PCE at 3.5, core at 3.2, Alex.
All right, and you also got your eyes on Samsung. Now, I know, or at least I don't believe it has any real tradable, ADR or anything in the U.S., but it's still a huge name when it comes to device installation and more. They had earnings overseas. Stock was under a little bit of pressure, I think, but the numbers are big again. So, Sam, what'd you find here?
Yeah, I mean, incredible numbers, blowout quarter. I mean, it did see nearly $90 billion in revenue. That was up 70% from a year ago. Operating profit growing more than eightfold in Q1, more than 750% of a jump. Obviously, a lot of this is to do with the memory demand that we are seeing. A lot of the growth is coming from the records as far as the demand we're seeing for that particular segment, as we are seeing softness in some of their other segments. They do believe that this is expected to stay strong in the second half of the year. In fact, analysts anticipate 2026 to be the best year for Samsung yet. And while you say, yes, it doesn't have a tradable ADR here in the US, I mean, we do look at names like Micron, which is obviously competing in the HBM space as well. I mean, obviously supplying to the likes of NVIDIA as well. I mean, SK Hynix and Samsung have been two massive names that we've been watching, obviously with SK Hynix with plans to list here in the US to capture some of that enthusiasm here in the US for memory as well. But I mean, look at this stock. I mean, it has rallied up, 90% or so year to date, and that's really helped drive the Kospi to these incredible gains we've seen as well. The Kospi actually notching its best monthly gain since 1998, Alex, throughout the course of April. So the index put on about 31% for the month. A lot of that has been driven by two names, as I mentioned, SK Hynix and Samsung, making up for almost half of that South Korean index, Alex.
Yeah, we think of this AI trade as a U.S.-centric one, but it is certainly an international trade, especially when it comes to some of those names out of South Korea in particular. Sam Vadas, I really appreciate it. Great setup. Looking forward to your program coming up in just about half an hour. Well, we're getting to the bells here, so we'll let them go. Alrighty, we are opening up this market. First prints up over 30 points for the S&P 500. That's about half a percentage higher. A percentage point higher, I should say. NASDAQ 100 opening up around 140. That's also up around half a percentage point. Russell 2000 real time here up about 10 points, and the Dow Jones up about 250. So green across the screen on the heels of what we've discussed, much already. These mega cap tech earnings. Taking a look at where Amazon opens, it opens up about 3%. Meta down about 8%. Microsoft sinking here a little bit too, down about 3% as it drags down the market with it just a bit. And Alphabet, the shining star, up about 7%. With that, we'll welcome in Diane King Hall, fresh off of morning movers here, Diane. We're going to start with some of these other names that reported as well. Qualcomm. This would normally be a big news maker, Diane, but it's just overshadowed by some really big tech players reporting on the same day.
It is, but it is a big mover today. That stock is rallying about 10% right now off the back of its latest quarterly results. It did beat expectations on the top and the bottom line. Adjusted EPS coming in at $2.65. That was a beat. Revenue coming at $10.6 billion. That's a slight beat. Under the hood, there's some divergence there. The strength was in automotive. That was the standout growth driver here. That's up 38% year over year. Now, we know, Alex, you and I and others have had this conversation about its handset business. That was down. It was down 13% year over year. So there is some ongoing smartphone weakness. But the automotive and Internet of Things, those were big standouts. Internet of Things up 9% year over year. So that shows just steady diversification here. Investors, the guidance for the current quarter is a little lighter than expected, but investors are clearly looking past this because Qualcomm talked about their push into AI and data centers, including this custom chip deal with a hyperscaler, major hyperscaler. They say it's going to start shipping later this year. They highlighted agentic AI. They say that's a key growth driver here. Wall Street likes the story today. Now, it's coming off of that pop that we see out the gate. It's up about 7% right now. But overall, investors like it. Again, what is working is automotive and Internet of Things. Licensing was up a little bit, about 5% year over year. So solid number there. It's a stable contributor to its overall numbers. So it shows that Qualcomm is successfully diversifying beyond smartphones because that's been one of the things that's been a hang up for investors. Alex.
Let's talk some cruise liners. Royal Caribbean is also on your radar, and this has my favorite thing we do as market commentators. I see the headlines are using the phrase better than feared. Diane, so that doesn't usually mean great, but good enough.
Yes, in this case, because it also points to some strength with the consumer here, or resilience with consumer. We'll use that terminology. So shares higher by more than 5.5% right now. They beat on the bottom line. Top line was essentially in line with estimates. Bottom line earnings coming in at $3.60 per share on an adjusted basis. Revenue did rise 11% year over year, hitting that $4.45 billion. She was looking for $4.46 billion. There's resilience over here because one of the headwinds for this sector, like the airlines, has been fuel costs. We know that's been a sticky point. It's a heavy input cost. These cruise liners have been working on shifting towards LNG. That's a big part of their, they want to move to zero emissions. They want to reduce their carbon footprint. So they've been in this multi-year process of that. And obviously that helps. The transition to that will help in terms of dealing with fuel costs right now. But they're holding up overall, especially with elevated fuel costs and the geopolitical disruptions. Demand from here, April bookings outpacing last year. They say there's strength in last-minute bookings, so it shows that consumers are willing to spend and willing to pay up. They say that travel remains a priority even with macro uncertainty. Experience spending overall, we're seeing basically the takeaway here is holding up, especially because that's been a trend since the pandemic, right? And bookings have rebounded for Royal Caribbean since some disruption earlier of this year. And so we're seeing Royal Caribbean regain some lost ground this year because you recall it was a huge standout for several years now.
Yeah, no doubt about it. As I look at the stock in real time too, Diane, it's up about 5%. So certainly the market liking what they see. And now the last one on your list, Eli Lilly. This is a big-time tech firm, or healthcare firm rather. It had really soared towards the end of last year. Rougher start to this year, but bouncing back this morning on its own results.
Yeah, I want to say a shot in the arm, but I know that's not where the shots go for this one. They did better than expected on both the top and bottom line. Huge beat on that bottom line there, $8.55 per share. She was looking for $6.66 there. Those are the numbers. I just delivered them. Revenue at $19.8 billion. She was looking for $17.62 billion. Blockbuster demand for its GLP-1s, Mounjaro, Zepbound. Huge numbers there. Mounjaro surging 125% year over year. Zepbound up 79%. So it shows that the demand picture is still strong for Eli Lilly and its weight loss drugs. And that even comes as, they're confronting pricing pressure. And we know that Novo Nordisk has been dealing with that with regard to the prices of its weight loss drugs. But it's volume growth that's been driving the numbers there. So the demand picture is still strong there. Lilly seeing 2026 sales as high as $85 billion. They have a dominant lead over Novo Nordisk. Also, they talked about the rollout of the pill, the GLP-1 pill. So that's expected to be the next leg of growth here for Eli Lilly, Alex.
Good stuff. Diane King Hall with the updates. Eli Lilly up 6.5%. But you may have noticed the market, starting to sink here a little bit. A lot of that has to do with Meta Platforms, down over 10% post-earnings. We're going to take a short break, but when we get back, we'll be joined by David Traynor, the founder of New Constructs, to explore what's been a very big week for big tech. That and more right after this.
While others recap the news, I help you read between the lines, from what's moving markets to what's next, with sharp takes and market know-how. Follow me on all social media platforms at Diane King Hall, and connect with me on LinkedIn for more.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
Welcome back to the opening bell. I'm Alex Coffey in for Nicole Petalides here on this Thursday morning, a morning that's seeing the NASDAQ go from green to red in early trade. We're now joined by David Traynor, the founder of New Constructs, to get his initial reactions to what's been already a really big week for big tech, and we're not through it just yet. David, good morning to you. Thanks for joining us. Pretty critical week, a lot of earnings on the same day, a lot of big-time spenders. What do you make of all this CapEx, and particularly names like Meta that just keep on spending?
Yeah, Alex, thanks for having me. Look, I think we're seeing a major changing of the guard. We're going to see a structural decline in the profitability of these major, previously super profitable tech companies, because CapEx at this scale is just going to do that to whatever company it is. And we published back in November a piece talking about the AI winners and losers, and we identified which companies had the cash flow, had the checkbook to keep writing the big checks required to stay in the AI race. Meta isn't one of them. And so we think they're going to struggle to keep up. That's why we're seeing layoffs across a lot of these less profitable big tech companies. I think we're going to see that the emperors don't always have the clothes we think, and when it comes to the balance sheet and the ability to spend at these sort of super high levels. And that's why we're going to see stocks like Meta suffer on days like today.
Is there any other names that stand out to you that kind of fall into that same camp? Maybe, as you said, the emperors standing with no clothes, maybe a little bit of false confidence in some of these names?
Yeah, well, back in early November, we pointed out Oracle because we also identified around $250 billion in off-balance sheet debt. Meta invented a new category of off-balance sheet debt, which we covered in our newsletter, called residual value guarantee. And they're creating new ways to hide what they're doing so that people don't realize just how much they're struggling to keep up with the poor economics of this AI build out. And I think the biggest problem, Alex, to me is that, look, despite all this infrastructure build out, we still don't have good data for these AI models, right? I mean, you ask an AI model why it lies so much, and it gives you 7 really good reasons. And so I think, this AI race is going to go on for a long time, and we think Oracle, Meta, Amazon, those are the firms that are in the race now, but we think are going to struggle to stay in it.
Yeah, it's funny that you say that. I mean, you talk to some of these, whether it's Claude or GPT or Grok or whatever, pick your poison. Never do you leave a conversation feeling so smart. I mean, it's, you're right. Thanks for saying that. Thanks for pointing that out. But Alphabet, hey, keeps on running here. We're going to hear from Apple. Apple, I love the dichotomy between Apple and Meta because they're two really important names to kind of just what everything looks like in 2026, but they've taken very different approaches to how they've looked at AI. Meta, of course, spending. Apple kind of sitting back and hoping to play kingmaker and watch this horse race and pick a winner towards the end. What do you think about that approach, which is, of course, the complete opposite, really, of what we've seen from Meta?
Well, to the winner goes the spoils. I mean, Apple can afford to sit and wait because of its great network, because its great services offering. So they can plug in a new feature and immediately monetize it. They don't necessarily have to build it on their own. And I think it's a smart move by Apple. Not to mention that they've got an enormous amount of cash and cash flow, cash on the balance sheet and continuous cash flow to pay as much as they need to get what they need to stay up in the race. Whereas Meta, look, they're sort of the weakest sister in the race here, and that's why you see Zuckerberg throwing haymakers, whether it's to acquire talent or to spend on AI data centers and compute, to try and stay in the race with the big boys. And so I think it's a great dichotomy to point out, Alex. And I think Meta's doing what it's got to do to stay in the club, and Apple is enjoying the fruits of its spoils because it's been able to be so profitable and have such a strong business model. It's got a wide moat and it can afford to do what it's doing.
Before we get into some of your picks, I got to ask you, there's also these names that are just sort of sitting in the background. Maybe they are formerly Bitcoin miners. Maybe they're power companies that are working on things like nuclear. That are just benefiting from this, I don't want to say reckless, but let's say exorbitant spending of companies like Meta or the build-outs for some of these things. Do you got any general thoughts on sort of those tangential plays that are just sort of sitting there and collecting the checks?
Yeah, I mean, look, when one of the players sort of is revealed to be false and they can't cash the checks that they've been writing, the whole thing potentially falls apart. There's a lot of sort of incestuous investing going on in the ecosystem where, you're borrowing from one firm to pay another firm, or, NVIDIA investing in all these companies to then be customers for them. And, like the deals with CrowdStrike, and they're all a lot of, like the residual value guarantees with Facebook, for example, or Meta are really about them. Hey, we're investing in this data center, but we're also going to be on the hook if it doesn't work out. And so, a lot of firms going all in. And if we see a few people have to push away from the table because they don't have the chips to stay in the game anymore, it's going to be them and all the firms depending on them that will see the fallout. So it's a high stakes game. Anytime you're talking about $2 trillion in investing, Alex, it's a high stakes game to say the least. And there are going to be a lot of players that are going to feel the fallout if any of these firms do end up giving up the race.
Well, you mentioned Oracle, too. They're not doing it with free cash flow. They're doing it on credit here, too. So it's certainly interesting. But I want to get to your stock picks. You got some ideas for our viewers here that, to be honest with you, I haven't heard from others. So I'm interested to hear the case.
Yeah, so look, we like MPLX. It's a great what we call a middleman player in the energy industry. We're bullish on energy in general. Look, we think obviously data centers are going to need a lot of energy. We also think that the general sort of progress of civilization as people become more successful and standards of living rise, energy demand goes up, and we think that that's going to be something that's inescapable over the years, and MPLX is priced as if its profits will permanently decline. We're also a big fan of CVR Partners, ticker UAN. It's in the fertilizer space. There's a structural limit on the supply of fertilizer. Their margins are super high. Their profitability is great, yet the stock price implies profits will permanently decline. And it's a similar story with an auto supplier called Autoliv, ticker LIV. They supply safety features, airbags, seatbelts, things that are actually, whatever's happening in an automobile, whether you're driving it or not, safety features, like they go in one direction. No one's ever bragging about how their safety is in decline. We're less safe now. So it's a sort of a counter-cyclical opportunity. But the one thing that all these stocks have in common is that their valuations are very attractive. And we've been moving away from tech for a long time. And we did pick some semiconductor stocks in the last year or so that done extremely well. We found the few that were still cheap. But we don't chase the expensive stuff, Alex. All these stocks are priced as if profits will decline, and we think those expectations are way too low, and that's why we like them.
David, it is truly always a pleasure, and we appreciate the the time, and look forward to chatting again soon. That's David Traynor, the founder of New Constructs, with some thoughts on big tech and a couple stock picks there at the end. We're going to take a short break. We get back. Kevin Green's going to join us, give us some key levels to watch. Be right back.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Opening Bell. I'm Alex Coffey in for Nicole Petalides. We're now joined by Kevin Green, Senior Markets Correspondent for the Schwab Network, and he's going to help us point out some levels that are on his radar here. Kev, I know you've been watching 7,100 and 7,200 for the S&P. Anything changed?
No, we're still within that range here, Alex, but we actually did have a lot of activity starting off today's session. Obviously, we had the Mag 7 names reporting yesterday. We did see a spike in options activity as soon as the equity market opened. That's kind of normal and par for the course here. And now we are seeing kind of this gyration or this rotation within the market, but we have been able to hold this kind of range over the last couple of trading sessions here. First area of support that you want to be focusing on is 7130. That's been kind of where we had some buyers really stepping in here. Especially since Tuesday, or since Monday and Tuesday. But if you're looking for another downside move, 7,100, something to keep on the radar. 7,200 to the upside is obviously going to be that call wall here. Now, you do see volatility actually edging to the upside. And I think what's actually very interesting here is credit spreads continue to move higher, or they're inching higher, while volatility on the equity front is still relatively low. Usually credit spreads moving higher is actually a leading indicator to equity volatility. So I'm kind of curious to see how this actually pans out here, as we've seen this kind of disconnect over the last couple of trading sessions. Liquidity levels, at least to start off today's session, was also relatively low. So that's also leading to some of this this volatility over the first 15, 20 minutes of today's session.
Appreciate the insights, Kevin Green. Always a pleasure. So as we say goodbye to one Kevin, we welcome in the other Kevin. Again, going in reverse this time. It's time for our market meetup. We're joined by Kevin Hinks again here, bookending the show here for us. Kevin, I'm sure it was a little loud there at the SIBO off the open. Nice green day, turned to red. We're kind of oscillating around unchanged now.
Not surprising, Alex, that when we're consuming and digesting so much information, that you're going to get a couple swings before the dust settles in the market. And yeah, there was, an up open, a pretty violent sell-off, and now we're drifting about, 0.2 up on the S&P and virtually unchanged on the NASDAQ. So I think that, we're still trying to figure out what crude oil is doing today, down with what appears to be heated rhetoric coming between Iran and the U.S. So, Alex, the dollar's down, crude oil's today, but we just got to convince the stocks of that so far.
Kev, we're also joined by Ben Watson as he's joining us as well. Ben, what stands out to you? What are you watching here this morning? We're now 20 minutes into trading.
Well, I'll tell you what, we're in the middle of earnings season. As Kevin and everybody have talked about, we've got these big Mag 10 and Mag 7 earnings that are coming to the table. And I think, to Kevin's point, if we do get that kind of risk-on parlay into the individual stocks, and including names like Apple, for instance, which is the big one on the table for this evening, I think that becomes kind of the area where investors start to focus that effort again as it rolls out of the energy complex, as it rolls out of some of these other kind of volatility instruments. So that's maybe where investors start looking going into the end of this week. You see Apple maybe coming up off of this 266 support, without a lot of momentum yet here at the open, but this earnings announcement, which represents kind of a change in leadership moment for Apple, just like we had with the Fed, I think this could be some fireworks if it gets above that 276 level, Alex.
Yeah, we got your chart there up on the screen. Perhaps some bearish momentum there with that trending lower, but we know earnings can have a lot to say about it. So I'm fascinated in this report, Mr. Hanks, because this is the opposite approach. I've said this to basically every guest. They've taken the opposite approach of Meta. Well, they're slamming Meta this morning, so we'll see if they're rewarding a little bit more prudent, conservative spender of free cash in Apple. What do you make of Microsoft sort of playing linchpin, though, this morning, Kev? I mean, Microsoft was closer to unchanged pre-market. It's down 4% now. I guess I'm not surprised to see NASDAQ red after that big change.
Yeah, Microsoft, I went through all the numbers, Alex, and clearly what the market's reacting to in Meta Platforms is that CapEx spending. Mark Zuckerberg just won't let that number even plateau. And so they're worried about the monetization. Microsoft put up pretty solid numbers and actually talked more about moderating CapEx spending. And their numbers were solid across the board. So I thought Microsoft actually put up pretty solid numbers but remember, the stock had run so much into the earnings event. There may be a little bit of profit taking, but overall, I think Microsoft is one of those, if you want to bet on one that might move and come back the other way, it might be Microsoft, because I had a tough time finding anything really not great about their earnings report. Meta, we knew this was going to be a CapEx, under the microscope. The one great thing about today, Apple's the opposite of that. They've been really low, not even participating in CapEx. I think they're content with being the hardware part of AI, and everyone that does AI has got to come through that iPhone. I think they're so far at least content with that. That doesn't mean they're not going to partner or get in bed with somebody, Alex, but their biggest story might be, new leadership for Apple.
Ben, I can't help but look over the last 4 days of NVIDIA. Its biggest company by market cap in terms of value, makes a new high, and now it's gone 3 consecutive days of moving lower. But the amount of money swinging around is incredible. This is something like a $250 billion move off the highs just a couple days ago. I mean, that's 2 Starbuckses. Starbucks is like $115 billion in market cap in total. NVIDIA is just swinging around on no news, twice that in a couple days. What do you make of that?
Well, I'll tell you what, Alex. I mean, there's a reason why it garners so much attention, is because it is that large just in terms of that market cap, and you get small moves that reflect that kind of larger potential. But I like the way that you characterize that in terms of the comparison to other stocks and other names that maybe we look at. You think about where all of that effort, all of that money has gone. Now that suggests, though, on the other hand, if we start to see a break, if there is a crack in that focus on NVIDIA, where does that money have to go? It's got to find some of those other names within the space, some of those laggards that haven't been performing as well. But what's interesting is NVIDIA has gone sideways for so long that crack just hasn't happened. And so I think you could see again that potential for a bounce. And I'll tell you what, that would be a grande potential move here, Alex.
Yeah, no doubt. And it's a really important part of the story, guys. So watching that is the one of the lone Magnificent 7 names left to report. We get Apple after the close. Looking forward to that. Thanks to Ben Watson. Thanks to Kevin Hinks for our market meetup panel. And that's going to do it for us here on Opening Bell. I'm Alex Coffey in for Nicole Petalides. We got Morning Trade Live with Sam Bottas coming up next. Have a great day.
She's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Schwab coaching is concepts brought to life in the real world.
Schwab coaching is learning constantly.
It's relatable, it's practical,
clear, understandable,
and hopefully entertaining.
Take it for what it's worth, but I think it's absolutely world class.
Schwab coaching is actionable, individualized, community, growth, and empowering.
It's really a human touch with your investing.
We have coaches who have been in the industry and around the industry for a long time.
So the nice thing about Schwab coaching is that clients get access to 9 different sets of expertise.
We want to engage with you and chat on the shows we host. We want to engage with you outside of the classes we host.
A consolidation that could add to this trade, so we shall see.
We have different formats because people learn differently at different times.
If somebody's a real bookworm, we've got courses for you to learn from. They can dig in, go at their own pace.
We have webcasts running through YouTube all day, every trading day.
We've got this ongoing 24, 25 times a year events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
They're kind of helping each other learn step by step along with the education that we provide them as well.
We're going to be able to help you regardless of where you are on that path of education.
It's really unique, not just that it exists, but that you can tap into 30 some hours worth of it each and every week. How incredible is that? And it's free.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
Good morning, everybody. Welcome to Morning Trade Live. I'm Sam Bartis, live from the floor of the New York Stock Exchange. We have plenty to hit on both here and abroad over the next hour. Here is a look at what is coming up. We'll dive into the latest CapEx numbers for big tech. After the latest earnings reports, how will the increased spending impact the overall market? And in the next hour, we'll have example trades for SanDisk and Apple, both companies reporting earnings after the closing bell this afternoon, and no doubt going hand in hand with some of Apple's comments around memory. But let's take a look at where markets are trading around half an hour into the session, particularly off the back of 4 of the Mag 7 members heading in opposite directions this morning following their earnings. We'll dig into all of that throughout the course of the program. We've got the S&P 500 just flat as a pancake right now, as coming off a bit of a directionless old session yesterday as well. The NASDAQ 100 down 0.2%, and that is perhaps coming from some of the push and pull we are seeing beneath the surface from these Mag 7 names. You've got Google with a percentage gain of 5.8, whereas Meta is down 9.7 right now. So we'll dig into some of that. The Dow Jones managing to hold its head above water, though, 0.8% higher, 408 points, and the Russell 2000 up 0.3%. Certainly, as we've come off as far as yields are concerned, 2s, 10s, and 30s, coming off of what we saw yesterday off the back of that Fed decision and Powell's commentary as well. Taking a look at foreign markets, so right now we've had a lot of central bank action out in Europe this morning. We'll get you across the BOE and ECB's decision to stand pat on their rates later in the program. But for now, it looks like some optimism in European markets. The DAX up in Germany is 0.7% higher. The FTSE 100 out in London right now 1.3% higher. The Nikkei 225 playing catch-ups after a market holiday yesterday, down 1.8%, and the Hang Seng Index trailing by 1.3 right now. So a bit of a split picture across these global equities, and taking a look at some of these futures products as well. As I mentioned, we're seeing yields coming off across the boards now. 10-year right now yielding at 439. We had crossed 440 yesterday. Taking a look at the dollar index this morning, this is slipping, and keep your eye on dollar yen this morning because we've had some jawboning out of Tokyo. We did cross that politically and economically sensitive 160 level, and we are currently changing hands with the US dollar 156 right now. So keeping an eye on that. Gold right now catching a bid as some of that greenback strength has come off. So 46.30, 1.5% higher. Crude oil is taking a breather, and that seems to be what is helping put the wind back in the sails of some of these stocks today as well. So 105 right now. So not the sort of levels we were talking about yesterday, but still in high triple digits. So just keeping an eye on that, particularly as Brent is still at 114. Bitcoin catching a bid as we do see somewhat of a tech rally in some names today. We're at 76,625 right now on BTC, up around 1% in the session. So there's a quick look, particularly off the back of the first corporate read from some of the biggest companies in the planet, which, as I mentioned, looks like a bit of a split picture today. Obviously, we've got a lot of data coming through this morning, as well as central bank decisions from around the world. So let's get out to Kevin Green, who joins me just to get through some of these macro numbers. Obviously, Q1 GDP up 2%, looking resilient. PCE 3.5%. Core 3.2, personal income 0.6, and initial jobless claims, KG, 189,000. I believe that's the lowest people are saying since the 60s. Choose your own adventure. What's it all telling us?
Well, I think it's still a little bit of a mixed picture. That GDP number, as you talked about, 2%, still lower than the street's expectations of 2.2%. And unfortunately, what we have seen for the revisions, as that number will be revised about 2 more times here, we have seen the revisions to the downside. So hopefully we're able to kind of manage and hold that up. Now, if you're looking at personal spending, that actually came in relatively strong. So even though we have inflationary pressures here in the near term, and that's reflected not only by the GDP PCE data, but also the PCE data that we get on a month-over-month basis, consumers continue to spend, and it's not only just on gasoline. So that is something to note. Initial claims coming in really, really light here. Now, is there some seasonal effect there, Sam? I think that might be a good question. But overall, the high-frequency data for the labor market is still reflecting a very strong job market, even though the monthly BLS data is actually coming in relatively weak, especially post the revisions, which, once again, looks like we have flat jobs growth on a year-over-year basis. But I think the inflation data, if you're looking at headline PCE, that came in at 0.7% on a month-over-month basis, really hot. You know, I mean, gasoline prices are moving higher. We can see it on the retail front. We were expecting that to actually continue because of certain refinery bottlenecks, as well as the amount of exports that we have going out of the United States. So giving summer driving season, the fact that consumers continue to spend, you're drawing on supplies, that means prices generally do go higher. So unfortunately, it's not really the data that you'd like to see when it comes to the Fed, but if the labor market's able to hold up here and we do find an end to this conflict, maybe they call it transitory, or maybe they believe that it's going to kind of reverse here. What's going to be the scary part is if this conflict does continue, let's say for another 3 months or so, do we start talking about that stagflationary environment a little bit more? Right now, you're seeing the signs of it, but it's early in the conflict. So once again, the market's kind of discounting that maybe stagflation is here to stay.
Yeah, and it seems like the US is in better shape compared to the rest of the world, particularly if you take a listen to some of the language we got this morning from the Bank of England and also the ECB. So keeping an eye on that, particularly as the market is very much pricing in rate hikes coming from those respective central banks. But yeah, interesting moves across the board this week. All central banks pretty much, as far as the major economies are concerned, sitting on their hands waiting to monitor that situation, as you spelled out, just because we are, so to say, getting tinges or at least of stagflationary light type of of situations playing out here. What about the earnings, KG? Because obviously we've had some time to digest what we got from 4 of the Mag 7 last night, and we're seeing the subsequent reaction. I mean, it feels like a tale of two corporates between what we're seeing between Google and Meta this morning.
We are. And Meta, if you're kind of looking at it, obviously getting hit to the downside here. For Meta, it's going to be interesting how the market actually reacts to the $600 level. We have seen some buyers stepping in. So on a daily, if you're looking at the today chart on a 1-minute basis, we are having a consolidation at the $600 level. Maybe some buyers do step in. We have seen this in the past, especially the last couple of weeks, where stocks have gotten hit hard in pre-market trading, and then buyers try to incrementally step in, and then it finishes off relatively strong. Humana had the same type of situation the other day, which dropped about 5%, ended up the day up 3%. Not sure if that's going to happen, but that is something to watch. I think Google Alphabet, obviously the fundamentals match the price action that we have seen over the last couple of weeks, beating both on the top and bottom line. Google Cloud revenue growing by 63% on a year-over-year basis. They're increasing their CapEx spending by about $5 billion. That's their guidance moving forward. But they're telling you that they are actually monetizing AI, and they are taking market share from others within the cloud space here. That has been a positive. So the shares are a little bit lower from the pre-market highs, but we're still up about 6%. This is a really good performance when it comes to Google Alphabet, and this is also giving maybe some power and credence to some of these other names out there that have exposure to the data center space. And that's exactly what we're seeing, is at least for now, when it comes to the makeup of the top performers of today's session.
Yeah, I mean, it very much goes to show why Google Alphabet has been the best performing Mag 7 stock over the last year as well. I mean, some had been saying the bar is so high that perhaps not much upside potential here, but once again, we're seeing it this morning off to the races, a very nice gain of 6% at the moment. What about Microsoft? I mean, down, what, 5.2% right now? We had seen it under pressure post-earnings last time around, taking a further drawdown on some of the SaaSpocalypse concerns. The numbers didn't look too bad. I mean, the view out there is the story's not broken. Maybe expectations just got ahead of reality. But what is it that they said last night that we're seeing some sort of reaction like this? Is it because it had run up so much to basically levels where we were at before last quarter's report?
Well, we have seen some optimism when it comes to Microsoft. Obviously, it was really oversold in the multiple that it was trading at. I mean, it was sitting at about 7, almost 8-year lows at this point. And so buyers did step in. So I think that was a technical short covering rally that took place here, and rightfully so. I think the earnings announcement was actually relatively mixed. If you're kind of looking at the top and bottom line, it was both a beat. You saw 18% revenue growth on a year-over-year basis. Azure grew by 40%. They're guiding for that 40% for Azure growth moving forward as well. Once again, higher than the street's expectations. The problem that you have with Microsoft, obviously everybody's spending, but the problem that you have with Microsoft is not so much the spend, it's the margins. And they actually did see margins kind of contract here a little bit for some of their bigger revenue generating businesses. And that's the concern. It's not only just, do you actually lose seats? Do you actually lose top line revenue? But are you spending and outspending? And are you actually seeing that margin improvement? Or are you really just kind of keeping up with the trend that's within the industry? I think that's why you are seeing it sell off. But once again, key inflection point, $400. We're trading about $1.60 above that level right now. Let's see if some buyers really do step in at that price point and try to reverse this name. If not, and we get a little bit of a pullback for some of these Mag 7 names, not outside of the norm, Sam. We're post FOMC. We're post some of these earnings announcements. We may see a pullback for the broader S&P 500 down to that 20-day moving average, consolidate and continue to move higher. That would be actually healthy for this market rather than this consistent 1% or 0.5% days to the upside without any breather.
Okay, understood. We'll continue to watch that price action throughout the course of the day. KG, obviously we've got the dollar backing off, yields backing off, and oil lower as well this morning, which is no doubt helping equities. I'm just wondering what is driving the oil price today. I see there's some reporting around the fact that Trump is going to be briefed on potential military action against Iran, which is interesting because it comes off the back of yesterday when apparently he was telling Axios that the blockade is the favored approach over bombing Iran. So obviously, once again, we come into a morning where there's some conflicting headlines. Just walk us through what the catalyst is here.
Well, I mean, oil's been on an 8-day run. I mean, it's kind of had one of those semiconductor type of moves here as the geopolitical risk continues to kind of ratchet up. We are seeing maybe a proposal for military strikes in order to bring Iran back to the table. Iran did and has actually over the last week or so has had some military activity taking place as far as missile launchers and things of that nature inside the country in order to test their air defense. So that's another signal and sign that the market, from the commodity standpoint, has been focusing on here. And then we have the supply disruption that continues to kind of reverberate throughout the global economy. Now, yesterday we had some data coming out regarding the EIA data coming out regarding the supply of oil and the production that we are seeing. Sam, we are seeing inventory levels moving to the downside. Jet fuel demand is obviously higher, but product supplied last week was around 1.5 million barrels per day. What does that really mean? It means demand consumption, not only globally, but here in the United States, is going up. If you have demand going up, you have supply going lower, prices move higher. That's exactly what we're seeing at the pump today as well. A major revision to the upside for a lot of states right now on a overnight basis when it comes to retail gasoline prices. And we do have refinery constraints here in the United States that are taking place as well. So this is still kind of culminating into a bullish move for the energy patch, even though we are seeing a minor pullback to that.
Okay, makes sense. Yeah, I was looking at gasoline prices out in California, what the highest since 2023 now as well. Really appreciate it, KG. Thanks so much for getting us across the stories, the micro and the macro for us today. Coming up, we will dive into the larger market ahead of Apple earnings. Our next guests believe that the big story to watch isn't Iran, but rather the AI and continuing tech investment boom. Morning Trade Live is back after this.
I'm Nicole Petalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
We're back on Morning Trade Live. Caterpillar opening at a new all-time high this morning after beating first quarter earnings estimates and raising guidance. The backlog hit $63 billion at the end of the quarter, a company record, and a near 80% jump year over year. Sales in the company's power and energy business, which serves AI data centers, rose 22%. So that, of course, being a component of the Dow, helping things out on that index today with this 9% gain on Caterpillar. Let's take a look at some of the other leaders on the session. You've got Teradyne up there with a nice double-digit gain of 13.5%. Qualcomm as well, 13.3% off the back of earnings too. Quanta Services up almost 12%. And as you can see here, Caterpillar is amongst the bunch, up 9.2% right now. Let's take a look at some of the losers on the session. We've got Willis Tower Watson down 14.5%. Meta off the back of this earnings and some of the concerns around the spend there, down 9.9% right now. International Paper down 9.5%. KLA Corp down 7.2%. That coming off the back of its earnings that we got as well from that particular company. All right, joining us now is David Bailyn, who's the founder of CIO Group. Thanks so much for joining us, David. And obviously on an important day where we've had a lot of macro and micro to chew on, it feels like the AI trade kind of took a back seat when the Iran war and that conflict erupted. But then it said, hold on a second, oil, you're not driving the bus anymore. We're back in charge. We got to record highs once again on the S&P and the NASDAQ. I mean, we're on track for, what, the best month for the S&P 500 since November 2020. Why is that?
Well, the one word is earnings, and I think you're seeing some pretty extraordinary earnings numbers. You've just put up a bunch of those, in some of the industrials, some of the power companies, some of the beneficiaries, right, of the war itself have been substitute energy producers and a lot of switch in the energy patch. The negatives, right, are all macroeconomic, right? The fact is that the U.S. would have a growth rate of 3.5% if we didn't have the war going on, right? It would have a 4% growth rate if we didn't have tariffs. With both of those things in place, that's what's holding the market back. So what AI means is not only an infrastructure spend, but also a earnings improvement story for the United States and ultimately for the rest of the developed world, because AI is going to cause earnings to go up and the majority of earnings are going to go to profits. So it's that conflict you're talking about. The long-term impact of AI and of this earnings improvement is the underlying story of why this market will probably be 10% higher than it is now by the end of the year.
And is there any concern around the narrowness we've seen in this market?
Well, there is absolutely some concern. And one of the things that we're advising investors to do is to add some of these lagging sectors. One in particular, which is healthcare. We really want people to be more exposed to it. And you're seeing some improvement in the earnings, but not in the stock price. And the reason why is that healthcare and technology are really not correlated with one another. So they provide broad diversification and the opportunity for profits in portfolios.
Do you think central bank tightening, I mean, not particularly here in the US, but globally, when you think about Japan, the ECB, and also the BOE, threaten the AI investment boom that we're seeing, which is obviously translating into earnings?
No, actually, what I think we really should be focused on is the fact that most U.S. investors, and especially family offices, are not adequately diversified to international stocks and into the beneficiaries of AI internationally at this point. U.S. portfolios are dominant. They have been for 15 years. The last 15 months, we've seen better performance from international shares. The circumstances you're talking about would favor adding international shares over the course of the next 12 months to portfolios, and especially those companies that are going to be beneficiaries from AI and from the commodity boom associated with it.
Where, David?
Well, specifically, we like Southeast Asia is a good place, and certain of the Latin American stocks specifically associated with commodity growth.
Okay, what about softwares? Because we speak a lot about hardwares. Obviously, softwares have really struggled coming into 2026. I mean, we've seen multiple compressions across the board. We've seen some of these stocks get absolutely decimated on some of these AI disruption fears. Do you see any opportunity in that sector?
That's a great question. It's one of my favorite areas. So when you think about it, right, why are cybersecurity shares down so much, right, which are providing essential software? And everyone believes that AI will replace cyber, right? But if you take a look at CrowdStrike or Palo Alto, you can find companies that are going to be direct beneficiaries of the increased risk associated with cybersecurity. And the same is true largely in the defense sector, which has been down for reasons that make no sense given the escalation of war in Iran, but also the need to build up defense capabilities all throughout the Western economy. So these are areas, right, both software, as you talked about, and also in defense, which I think are great opportunities over the course of the next 24 months and really are being swept away, for reasons that don't make fundamental sense.
Right. I mean, some have argued that some of the AI SaaSpocalypse type of narratives in this market have been a bit overblown when it comes to certain companies. But if investors are looking to take advantage, perhaps, of this valuation reset, if you want to call it, where would you be looking? Because it feels like it's been a case of just shoot first, ask questions later, throw the baby out with the bathwater.
Right. Well, just take a look at some of the companies, right, that do hardware and software combinations like Axon, which is a company that, produces an actual good, right, for safety that's going to be a beneficiary of AI, right? So anything where you have an embedded technology which will be enhanced by AI, especially those hardware and software combinations, are the types of companies that you can add now that have done very poorly as a result of what you said, right, which is this sort of implication that AI is going to ruin all software, and that is completely incorrect. And there are many others of those, and you can even buy, a broad software index at this point, those, and sub-indices that would be very good to add to portfolios. It is completely overestimated the impact that AI is going to devastate all of software.
Okay, David, really appreciate it. Thanks so much for jumping on and joining us today. David Bailyn, their founder, CIO Group. Appreciate it. Coming up, we'll get a closer look at the big picture with the team from Charles Schwab. Morning Trade Live. We'll be right back.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network. Back on Morning Trade Live, Royal Caribbean rising this morning after the cruise line beat earnings estimates, and executives said that demand is recovering to pre-Iran war levels. Despite the demand recovery, Royal Caribbean lowered its full-year guidance, and its second quarter earnings outlook came in below estimates. The Iran conflict had been weighing on the sector. On Wednesday, RCL closed at its lowest level since December 9th. But of course, we do have oil prices coming off this morning. No doubt that is helping some of these consumer-facing names, particularly in the business of travel. Royal Caribbean's up there 7.9% across the cruise line stocks today. Carnival up 5.6%, Norwegian and Viking both up 3.2% respectively. So obviously a nice day following RCL's report and response from the market in tandem and moving in sympathy across the cruise line sector. Welcome back to Morning Trade Live. It's time now for the big picture. So let's welcome in the team from Charles Schwab. We are joined today by Joe Mazzola, Head Trading and Derivatives Strategist at Charles Schwab, Jim Ferrioli, Director of Crypto Research and Strategy, Schwab Center for Financial Research. Okay, Joe, so the tape's a bit mixed today when you take a look at the reaction to all these spending plans from the Mag 7 and then the data. I mean, particularly when you look at Q1 GDP, PCE and claims, how are you tying it all together?
Well, I think, this market, it continues to be priced off of earnings and earnings expectations. Earnings been good. I mean, Sam, I think we got to, really kind of point that out as we're around 80% beats from an earnings perspective in terms of the S&P 500, about halfway through in terms of the names. And even if you look at the mixed reaction function for the 4 mega caps that produced, really solid earnings yesterday, it's the guidance, it's the CapEx spend, and it's the kind of not what have you done for me lately, but what are you going to do for me in terms of that CapEx spend, and how is that going to show any type of revenue growth or margin expansion going forward. And I think if you look at the two companies that were able kind of to delineate that the best, that would be Alphabet and Amazon, and they were the two that are doing well, or at least we're doing well at the beginning of the day. And the companies that continue to show increased CapEx spend, but haven't. That's not fair. I would say Microsoft actually was able to kind of show where they are kind of monetizing that spend. But Meta comes out with a $25 billion potential bond offering on a 40-year jumbo, and they're paying the price for it today. So it's. To me, it's about free cash flow and whether or not they can generate that without having to go to the debt markets.
Yeah, and it seems to be a margin story for Microsoft right now as they continue to spend as well. Jim, just getting over to you and switching gears to the world of crypto. Obviously, Bitcoin's well bid today. I'm just wondering, how long you anticipate this has legs, given that you have talked about the challenges to the durability of any near-term strength in this market.
Hey, Sam, good morning. Yeah, there's a couple issues here. So first and foremost, we've had a reignition of the narrative about institutional adoption. New spot ETPs have been launched. Obviously, at Charles Schwab, we're launching spot trading, and that's led fuel to that narrative. Coming off the bottom that we reached in early February, Bitcoin's staged a pretty meaningful rally, but we've really run out of gas around $80,000. And breaking through these levels gets a little more challenging here. If you look at the average cost basis across all crypto owners, or all Bitcoin owners rather, it's about $78,000. So it's natural to get some selling there. If you purchased, you were kind of deep in the red at $60,000. You might be happy to get your money back even. And again, if you look at another version of that, that just looks at the cost basis for the spot ETP products, that's at about $82,000. So there's a lot of fundamental selling there. The $80,000 level is significant as well. In the fall, when Bitcoin first started selling off, it had actually support at $80,000. Earlier this year, it broke through that level, and that's when it ultimately traded down to $60,000. So again, we think that this is going to be kind of a meaningful area of congestion, and you will really need a fundamental catalyst to power the market maybe to higher levels. And we don't really see anything happening for more of a sustainable rally standpoint till the second half of this year.
Okay, yeah, that's certainly what I've been hearing as far as the consensus. I think many people are eyeing September as far as that cycle is concerned. And Joe, just getting back to you and focusing a little bit more and digging into this macro, I mean, obviously a lot of information this morning. I'm just wondering, with Q1 GDP at 2% and subject to 2 revisions, which we've seen obviously Q4 slashed pretty much in half, when the PCE is running a bit hot as well. I mean, yes, in line, but still something to keep an eye on. You know, how you're thinking about the data right now, given everything Powell said yesterday and how the central banks are keeping an eye on what is looking like potentially stagflationary-like kind of conditions creeping in?
I think you hit the nail on the head, Sam. I think it's exactly what's happening. And that, I think more importantly than what I'm looking at, I think it was what the market's looking at. It's able to kind of see through that right now, right? You know, the ECB and in their speech, their follow-up speech, and you know, similar to Powell. I mean, look, the U.S. is in a more favorable position, I guess, if you will, because of our less of a reliance on energy coming out of the Middle East and natural gas. You know, we produce that and we ship that out of the United States. So we are a little bit more buffered there. But you're seeing our partners are starting to suffer now. You're seeing that in Asia. You're seeing that in Europe, and they're now looking at, as you mentioned, stagflationary concerns in that prices are going up and they're not really seeing an expansion. They're seeing a contraction in GDP. So this is kind of led to a recalibration of all maybe efforts where we were talking about, are there going to be hikes, you know, here in the U.S.? Are there going to be cuts, you know, anywhere else in the world? I think everybody's just sitting on their hands right now and just waiting to see kind of what happens with the conflict in the Middle East. And the longer it drags on, the harder it makes it for those central banks.
Yeah, for sure. Obviously, the ECB saying going meeting by meeting. Jim, just getting back to you and looking for that catalyst, particularly as we head into the second half of the year, which could be obviously supportive for riskier assets, would be that Clarity Act. I'm just wondering, where are we up to with that? And what kind of market implication could that potentially have, giving the market that regulatory framework that it's really been needing?
Sure. So the Clarity Act is still being actively worked on in the Senate. No firm date on when we expect that to make progress. What we do feel its impact will be on the crypto markets is it will reinforce the narrative of institutional adoption. One of the things that happened a few weeks back, the SEC clarified already existing laws about how cryptocurrencies should be viewed. And so the Clarity Act would actually cement those. And so that would be a positive, but ultimately, you know, institutions have been getting involved the past few years. This is largely a retail-driven market, and a lot of these institutions are catering to retail clients. And so ultimately, we think it's more fuel for the narrative because institutional adoption has really been the story of the past 2 years. That said, crypto is a momentum-driven market, so any fuel towards narratives to the upside would be viewed as a positive. And so that's the type of environment where we typically would want to own the larger cap cryptocurrencies, right? Historically, off these deep bear market bottoms, Bitcoin tends to outperform the rest of the market cap. Ethereum, we're more neutral on. You're looking at activity on chain. If you annualize it, it's going to be coming in significantly lower than activity was last year. So, you know, there's less demand for Ether in that type of situation. And then we really have a less of a favorable perspective on XRP and Solana, mostly because XRP is going through this fundamental reinvention of itself. Is it a competitor to Bitcoin, or is it more of a smart contract platform? And investors like clarity, and this is kind of a turnaround story at this point. And then most of the activity on the Solana blockchain tends to be speculative in nature, meme trading. And so again, in an environment where altcoins were down much more than Bitcoin, you're less likely to have investors jump right back into that very speculative meme trading type behavior. And so that's why we think these are the assets that are more favorable relative to other cryptocurrencies. But that said, there still was a large correction. You could get some upside momentum in the second half of the year, but we would not expect the crypto market to make a new high in 2026.
Okay, understood. Gentlemen, thanks so much for joining me today. Really appreciate your time. Joe Mazzola, Head Tradings and Derivatives Strategist over at Charles Schwab, and Jim Ferrioli, Director of Crypto Research and Strategy, Schwab Center for Financial Research. Coming up, it's time for the morning trade. We'll take a closer look at memory stocks ahead of SanDisk and Western Digital earnings later today. Morning Trade Live will be right back.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
While others recap the news, I help you read between the lines, from what's moving markets to what's next, with sharp takes and market know-how. Follow me on all social media platforms at Diane King Hall, and connect with me on LinkedIn for more.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the CBOE, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
We're back on Morning Trade Live. Let's focus on memory stocks. It has been the best trade in tech so far in 2026. You can see it on this chart. Micron is up more than 60% this year, and it's the laggard in the group. Western Digital, Seagate have made greater than 120% gains in 26. And SanDisk is the whopper, up more than 300% going into earnings this afternoon. So memory stocks are very much the focus of the morning trade, with both SanDisk and Western Digital reporting earnings this afternoon. Of course, one more in the business of NAND and the other more of a pure play when it comes to that storage. So let's get to Marley Caden with a little bit of a preview. I mean, we've heard from the others, Marley. We've heard from Samsung overnight. We heard from SK Hynix and, of course, Seagate earlier this week. I mean, how high is the bar with, triple-digit percentage gains just in 2026 for SanDisk?
Yeah, I mean, you really laid it out there, Sam, with that 300-plus rise so far year to date. But let's take a look at the last 52 weeks. It's at 3,200% higher. So the bar is extraordinarily high for SanDisk. As far as revenue, they're looking for $4.55 billion. That would be up almost 170% year over year. These are the kind of numbers where we're double checking that they're accurate and there aren't typos here. For adjusted EPS, $14.11 is what we're looking for. It was $6.20 last quarter. Last year, they had a loss of 30 cents. So, I mean, if you take a look at that, they are expecting
expected to have a significant improvement here. Also have beaten on earnings in each of the past 4 quarters, so that makes the bar even just a little bit higher. Analysts very bullish on this name. Several price targets in advance of those earnings. Most of them seem to believe that this current memory cycle that has seen these 100,000% run-ups to these names could last longer than usual, supported by the steady demand from AI and the shift towards data centers, which they say are less cyclical than the industry is used to. So very high expectations for SanDisk, with a monster performance year to date going in.
Oh, absolutely. And then what about Western Digital, given that, of course, it's more of that sort of pure play cold storage type of name like Seagate? I mean, obviously, we got some clues from that company. What can we expect to hear from Western Dig?
Yeah, a slightly different company, maker of hard drives for businesses and personal computers. They are expected to post earnings of about $2.41 per share in the report today. That would represent a year-over-year change of more than 75%, which sort of pales in comparison to the 170+% for Seagate. But 75% growth is phenomenal no matter how you slice it if they can hit that number. Revenue expected to be $3.24 billion. That would be up more than 40% from the year-ago quarter, Sam. And analysts also very bullish here as well. 85% of the analysts who cover Western Dig have a buy rating or a buy equivalent rating on this name. There was only one sell rating that I could see. And in the past year on Western Dig, I know I highlighted SanDisk up more than 3,000%, but Western Digital up close to 900% over the last 52 weeks.
Yeah, it's just been incredible runs for some of these companies. We'll be watching this afternoon to see what they have to say. Marley, thanks so much for the preview of both those names. Let's trade SanDisk now with Joe Tighe, portfolio manager of the Rational Equity Armor Fund. I mean, Joe, 3,000%. I mean, this is just insane. How would you approach an example trade on that name?
Yeah, it's we're getting up there for sure. And we're talking about $1,100 stock now because it's come up so much, and that's really expensive to jump in here and buy. It's one of the reasons why I love using options on a name like this. And we don't really know what's going to happen after earnings, but if I were to buy 100 shares of this monster, it would cost me $110,000, and this could easily drop 10% on earnings. That would wipe out 10 grand in a heartbeat on that trade. A different way to look at it would be to use options, look to the upside. Now, this is very expensive still. I can make it a little bit cheaper to the upside by using a call. Butterfly, it's going to require me to hit my sweet spot here at 1,300, but I'm looking at the May 1,100, 1,300, 1,500 call Butterfly. It's $34.70 right now. That'll cost me $3,470. Yes, that's very expensive. I know for an option, a lot cheaper than owning 100 shares. Obviously, like I said, that's my max loss. If we go down, I'll lose that $34.70, and it is likely going to be wiped out on a downward move. But an upward move, this could turn into 20 grand if we hit that sweet spot right at 300.
All right, a good look at SanDisk. Obviously going to be watching some of these report cards tonight. Thoughts on the overall market? Obviously, interesting reaction. We're seeing Meta tanking, like 10% right now post-earnings. We've got a lot of data out this morning, so a lot to chew on for this session today. I mean, has any of it surprised you as far as the reaction, Joe?
Seeing big moves, I'm not surprised that much. Big fan of Google and Amazon, Alphabet. All those companies, I thought those quarters were fantastic. Really, we're talking about CapEx numbers, which are really big. It's going to be big for SanDisk, of course, on their earnings. But I like the companies that are spending money and making to make money. Google just is really amazing. The amount of money they're making already off of their AI. I think that is just kind of a sign of we are starting to turn the corner here from a point where we're all in hypotheticals. What could this AI do? Could this actually make anybody money? Google's already making money on it. So I think we're turning the corner. Really exciting time. And then, looking at the private companies, I think that's where we're going to be focusing a lot on. And of course, Amazon and Google are big players in those private companies. But we're going to be having some IPOs coming down later in the year in the AI space, looking at OpenAI, looking at Anthropic. I think the market is going to start focusing on that. What that's going to mean for all these other valuations, because they're going to get really big, really rich valuations. It's probably going to mean some of these other companies are going to be lifted up too.
Yeah, it's interesting because I had a guest on a couple of days ago who said they expect to see Google actually grow into its rich valuation in the coming quarter because of some of the investments it's making in Anthropic. And so they have this conference in May, which they actually believe could be an even bigger catalyst for earnings, than earnings, I should say. So we'll have to wait and see. Joe, really appreciate it. Thanks so much for your thoughts today. Joe Tighe, portfolio manager of the Rational Equity Armor Fund. Coming up, we'll take a closer look at the sectors on the move this morning and international headlines impacting global markets. Morning Trade Live will be right back.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
Welcome back to Morning Trade Live. I'm Sam Vardas, coming to you live from the New York Stock Exchange. It's time now to take a look at the sectors that are moving markets this morning. So I'm joined by Alex Coffey to get us across what is moving and shaking for us today. And obviously technology lower. We're seeing Meta tanking. I mean, you and I were breaking down these numbers yesterday, Alex. What do you make of the reaction we are seeing this morning?
Well, I'll start kind of high level, Sam, and I'll give you some numbers, and then we'll look at what actually is happening. And I think it's quite fascinating. If I were to tell you 9 of the 11 sectors are higher by an average of over 1%, 75% of the S&P 500 components are higher, one might think this is a pretty green day. Now, granted, we are above the unchanged line, but there's a lot of bright colors on this screen, Sam, and we're up 7 points in real time. That isn't that common. So it goes to show, and we talked about this leading into the results after the close yesterday, that the earnings were going to have a lot to say about what today's performance is going to look like. And for a while, especially in the pre-market as we were working towards the open, you had Amazon up, you had Microsoft kind of unchanged. I know Meta is going to get a lot of flack today, but Meta was down immediately. And yeah, it's gotten worse. It opened down about 5%. Now it's down about 10%. We'll talk about that more in a second. But all in all, to me, this is a Microsoft story more than anything. Microsoft is the linchpin in today's performance. It's sunk 5% since the open, and that's really changed the dynamics.
And it seems to be taking the softwares down with it, doesn't it? I mean, you've got the IGV on the back foot to the tune of 1.5% as well. Pretty much a sea of red across some of the key software names that we track off the back of that. So it feels like push and pull as to why we're seeing the SPX basically just treading the flat line at the moment. Interesting that equal weight is up almost 1%, which says a lot, to your point, around the sectors. What are you paying attention to the most? Obviously, the next cab off the rank is going to be Apple. Anything that sort of stands out to you about some of the other price action we're seeing today?
Yeah, I'm really looking forward to the Apple report because unless something drastically changed in terms of how they're taking their company in terms of direction, they're likely to tell us that they're taking a very different approach to what Meta is currently doing. And Meta's spending a ton of money. Apple's not spending that money. So if we're punishing Meta for spending that money, do you reward Apple for the prudence and the little bit more conservative purse? We'll find out after the close today, but Apple doing all right. It's up about 0.5% despite technology being under pressure. All in all, though, Sam, you mentioned equal weight. It's up 1%. You index this group, they're down over 2%. That's the story.
Yeah, and then obviously we've got some other earnings out. I mean, some bright spots being CAT as well, a Dow component, which is obviously helping out that index. A nice day for most of the chip stocks as well. But Alex, we'll have to leave it there. Really appreciate your time as always. Let's turn to what is making international headlines now. Samsung seeing operating profits grow more than 8-fold in Q1, beating expectations and setting a new record amid the chip boom. The South Korean tech company raking in nearly $90 billion in revenue, about a 70% jump from a year ago, while operating profits soared more than 750%. Samsung said it expects memory demand to stay strong in the second half of the year. Analysts anticipate 2026 to be the best year for Samsung yet. Turning to central bank action, the Bank of England kept rates on hold as widely expected this morning. The committee voting 8-1 to leave the benchmark rate at 3.75%. Governor Andrew Bailey saying it was reasonable given the softness in the UK economy, but he did signal they may need to hike if there is continued disruption to energy supplies. The market is currently pricing in 2 hikes from the BOE this year. And the European Central Bank also standing pat on rates as expected amid what it calls an intensified upside inflation risk and downside growth risk. The ECB says the economy has shown resilience but will continue to be data dependent and will act meeting by meeting, officials signaling they need more time to assess the impact of the Iran war on the economy. Coming up, it's time for Inside Out. We'll take a closer look at Apple ahead of earnings and bring you an example trade on that name when Morning Trade Live returns.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
My parents didn't really talk about money at all. In college, everybody around me had money. I didn't want anybody to find out that I wasn't middle class. I was using credit cards to do anything and everything. I ended up with $20,000 of credit card debt. That's when I kind of realized, like, all right, I have a money problem. This is about how my finances got wrecked and how I fixed it. And if I could do that, you can do it too.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Morning Trade Live. Let's go inside out on Apple earnings ahead of this report card. Joining us now, very pleased to say, is Paul Meeks, Head of Technology Research and Managing Director over at Freedom Capital Markets. Paul, always nice of you to join us. Thanks so much. So Meta and Microsoft getting heavily scrutinized today for their spending plans. Will Apple face the same punishment, do you think?
Well, Apple doesn't really have aggressive AI spending plans in their model. And of course, the other companies do. I think Apple's quarter is going to be fine to better than fine. There has been indications, particularly from customers abroad, of some near-term iPhone momentum. But I think over time, they're really going to have to solve the riddle. Is AI just going to be a feature on their phones? Because Apple, to accelerate its revenue and earnings and cash flow growth, really has to have AI in some shape or form be a very big, very significant, independent revenue driver. And so that'll be the case over the next couple of years. This particular quarter will be just fine. The company rarely misses, though the expectations are fairly low. Even for next fiscal year, Sam, The street is only expecting 7% revenue growth and 10% earnings per share growth.
I suppose that goes to show why shares have been relatively flat this year heading into earnings. I mean, it has been seen as one of the more stable of the Mag 7, maybe because it doesn't have that convincing AI story just yet. But I mean, how patient can the markets continue to be, Paul, with this story? I mean, if this is not the catalyst, does WWDC have to be in June?
You know, that's really interesting. But Sam, I've been confounded for years as the company continues to grow only modestly, the top and bottom line. The bottom line grows a little bit faster than the top line just simply due to share repurchases. But the company's trading at 29 times next year's earnings. And again, 10% earnings per share growth at best. And the S&P 500 is growing much faster and is priced at only 20 times earnings. So yes, sooner or later, they will have to show a catalyst in regards to AI.
Yeah, obviously we've seen this multiple compression across all the Mag 7 since the start of the year. I'm just wondering what metrics you're going to be paying attention to the most. I know you mentioned iPhone sales, but I'm just wondering as far as some of the services is concerned as well.
Yeah, so services obviously important, even though I don't expect the new CEO to be on the call because he doesn't take the throne until September 1st. I think there should be some discussion and will be some discussion about why he was chosen as Tim Cook's successor.
Means for innovation and AI moving forward. So no doubt plenty of questions that Cook will be thrown at in this conference call. Just wondering what they're likely to say about rising memory costs and trade tensions, and obviously a key market being China. I mean, will everything else manage to offset some of the challenges that they're facing with some of those issues right now?
Well, we're all going to be waiting for what happens with AI on Siri. Can that be a boost? Wouldn't necessarily be that impactful for memory prices, but there is no way around it. Their cost of goods sold will go up significantly with memory prices because this, at the end of the day, is essentially a consumer hardware company.
Yeah. Absolutely. And obviously, we've got some of the memory companies that are going to be reporting alongside Apple this afternoon. So we'll get a clear picture of that, Paul. Always appreciate it. Thanks for the preview today. Paul Meeks, their head of technology research, managing director, Freedom Capital Partners, or Markets, I should say. Let's trade Apple now with Tom White, host of Fast Market. How would you approach an example trade for this name, Tom?
Yeah, you mentioned the fact that it's flat on the year. It's kind of underperforming those other Mag 7 names. But as Paul mentioned, high valuations on this company and smartphone sales are going down, even though they're just coming off that super cycle. So the option market pricing in a modest 3.6% one-day move in either direction. So implied volatility levels aren't that elevated in this name. It has had a good run so far this month, but I think everything has. But going into this report, the bar's kind of low. So kind of setting up with what Paul anticipates here, taking advantage of that low implied volatility, using the option market to take a directional bias. I looked at a bearish put vertical here. I went out to the May 15th monthly option. So 15 days till expiration. It's not a pure earnings play. You've got some duration on this in case the stock moves higher and goes against you. In the May 15th, we're going to buy the slightly in the money 272.5 strike put. And then against it, to offset some of the costs on that bearish put purchase, we're going to sell the 255 strike put. So a bearish $17.5 wide put vertical that you're going to pay roughly about a $570 debit for. That's going to be your risk, $570 per spread. That can expand to $17.5 if it goes back down to the 255 level. If you pay that $570 debit, takes your break even down to $266.80 to the downside. That's only about 1.5% below the current share price. So well within that one standard deviation move that the option market's pricing in. And one of the keys with doing these directional biased verticals, this one's bearish, and you can do this on the call side if you're more bullish on a name, is that it gives you that flexibility as far as trade management. I've got 15 days in this position. But if I get the move immediately to the downside tomorrow and this starts to expand in price, that gives you that opportunity to close maybe an all or a portion of the trade prior to expiration. But you got about basically 2 weeks in this bearish position if you think the stock's going to go lower.
All right, we'll be watching this afternoon, sitting up just fractionally ahead of this all-important report card, the next Mag 7 cab off the rank. Tom, really appreciate it as always. And we're picking up steam across stocks right now. The S&P 500 up 0.4%. So we'll continue to watch this throughout the day with some of these key earnings later on this afternoon. Thanks for joining us here on Morning Trade Live. You've got Trading 360 up next with Marley.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world, I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Marley Caden coming to you live from our Chicago headquarters. Here's what we have coming up for you in today's show. The CEO of Hippo Insurance is here to talk to us about the financial turnaround for the company and give an outlook after earnings. That's all coming in our 360 Spotlight.
And Qualcomm is one of the leaders on the S&P today after reporting a beat on the top and the bottom line. The CEO saying that, quote, AI is reshaping our roadmap. We'll go through the numbers, Wall Street's response, and have an example trade for you in our disruptor. And the street is not responding well to Meta's earnings. Despite a beat on the top and the bottom line, the social media giant has upped its CapEx expectations for the rest of the year. Our 360 round will go through the numbers and the outlook and why we're seeing pressure today. Lots to talk about, but let's take a look at the markets and where we are this morning in this trading day here. We are green across the board so far. The S&P trading up 0.4 higher. We're at 71.65 here. The NASDAQ 27,255. That's up 0.25%. For the Dow, we are at 49,422. We've added more than 500 points today, up more than 1% there. And the Russell 2K at 2773. That is up 1.25%. The 10-year ticking higher, though. We're at 439. The dollar at 92. Gold is at 46.3330. That's 1.5% higher. Crude oil at $106 a barrel. That is lower than where we were yesterday, but still highly elevated and over that $100 mark. Bitcoin at 76,625. That is 1% higher today. I do want to welcome in our first guest, though, joining us, as always, Alex Coffey, here to take a closer look at Alphabet, which I think is easy to say was perhaps the clear standout in the Mag 4 earnings that we got yesterday. Really impressive numbers just across the board. Take us through what you think the highlights are here, Alex.
Yeah, stock's up about 6.5%. It's really put the market on its back in many ways. We talked about that yesterday right out the gate as it moved higher and continued to surge. The numbers are just really, really big in this case. Revenue almost $110 billion. That was up 22%. Services were up 16%. Advertising revenue was also up 16%. Both of those were ahead of expectations. YouTube ad revenues were up 11%, and they were slightly below estimates, so maybe something to circle. But Google Cloud continues to be the standout. It grew 63% year over year and eclipsed expectations by a pretty wide margin, Marley. It came in at $20 billion, pretty close to on the nose, and the estimate was for about $18.4 billion on that. So really impressive stuff. Again, we're talking about a company that employs almost 200,000 people, and it just continues to just set the bar for these big mega cap hyperscalers. CapEx did basically double year over year, but came in actually slightly lower than where the street was. So contrast that with Meta that continues to move things up. Alphabet, they're spending, but they're very much keeping things kind of buttoned up and according to plan. When you look at analysts, or I guess we should start with, if you look at what their CEO, Sundar, had to say, he said strongest quarter ever for customer AI plans driven by Gemini app. And we talked about the Gemini growth at the close yesterday. Just so impressive and makes sense, right? Like, they're a handshake into these technologies for so many. You're already used to going to Google to search for things. They've embedded that Gemini platform within their traditional search. And, you know, it's just one extra step to download that as a standalone app.
Yeah, I mean, it was really just across every metric, just such an impressive report to go through. I mean, their total paid subscriptions, I think, crossed 350 million. That was their strongest subscription quarter on record. They also saw their strongest revenue growth since 2022. And there were concerns about search, about whether search was going to, in some way, get usurped by AI, or we were going to see poor search numbers. In fact, all they did was show how durable and adaptable search is.
Yeah, and throw in the other category as well, their equity investments, making something like $37 billion as well. So tons and tons of things going right for Alphabet, and it shows why this stock continues to move higher. Analysts, though, liked what they saw. Evercore moved to 420 from 400. Truist went from 385 to 415. Citi was already at 405. And then Wedbush, I really thought it was important to point out what they had to say. They say it remains one of the top names in the AI revolution, given the vertically integrated approach across search, YouTube, and its ad cohort, which continues to accelerate. So big things ahead, perhaps, for a company that's already got big things going.
Yeah, it was all cylinders firing for Alphabet. Alex, thanks for taking us through those numbers. Really appreciate it. Alex Coffey, co-host of Next Gen Investing. I do want to broaden things out, though. Bring in our next guest. Joining us now, Chris Vermeulen, the founder and chief investment officer at the Technical Traders. Chris, great to have you back on this show. I'd love to just start with your reaction to the earnings that we got yesterday, some of the earnings that we got this morning. I mean, some huge names reporting, some very big numbers, and some very different responses to those numbers.
Yeah, I mean, we've definitely got a lot of volatility. Yesterday was a huge day. I think there was about 209 companies reporting earnings. So it was one of the busiest days. And we saw after the close, we saw some of the Magnificent Sevens, kind of the yin and yang. We saw Meta get hammered with shares down about 10%. We see Google, which you just talked about, surging on extremely good data. And, you know, I think we've seen a lot of the kind of the buy the rumor, sell the news type of move. And that's what we've seen with the earnings. We saw money rotating into equities over the past month. We've seen a very strong trend. I think maybe, you know, smart money has been buying into the rumor that there's actually going to be some strong earnings. And then today we've got the market. It opened up at all-time highs. And more or less, we saw a lot of heavy volume selling. And it's you know, buy the news, sell the rumor. The good news came out. I think a lot of companies, a lot of people are locking in gains. And this is typical price action. You see a very sharp pullback when there is strong earnings because people already anticipated that. And so now the market is trying to shake that off right now.
And do you think that's a healthy breather, Chris, when we see this, you know, selling even on the good news? Do we need those moments?
We do. I mean, you really don't want price to go straight up. The faster something rises, the quicker it usually comes back down. It's not a sustainable move. We want things to stair-step their way up, take their time. The longer something takes to rise, the more stability or stable it is for maintaining that growth long term. It's like the precious metal space earlier this year. Silver went parabolic, went straight up, and what goes straight up usually comes straight back down. It's not healthy price action. So this is really good. We want to see a pause, a pullback here. The equities markets have had a very strong run and trading sideways for a week or two on these good earnings, which would defy what most people will think. You think good earnings, higher pricing, but this is the way the markets typically move. A nice sideways move or even a small drift down is just going to be restabilizing the markets, and then I think we could have another run higher.
And what's it going to take for that next run higher? Are we going to have to wait for NVIDIA? Is it just a couple weeks of downtime and we'll wait for the next huge name to report, or might it be a different catalyst?
I think a lot of people are waiting for NVIDIA, but overall, I mean, I think the broad market, I think investors are just going to simmer a little bit, take a bit of a breather. I think the underlying trends and tides in the market we're still seeing money flowing in. People are very aggressive right now. We're seeing micro cap stocks, small cap stocks muscling their way up. We're seeing a lot of different sector ETFs that are in the growth space running and having big gains. So people are really moving into that growth space. They really want to swing for the fences. We've seen like boring kind of sectors like utilities, things like that move sideways and move lower. And same with precious metals. They've drifted sideways over the past week or so, while stock market has ripped higher. And that's because people don't want boring things. They want to get into fast growth. And so I think we've got a very bullish sign here. I do think it's a little overextended, the markets. And I think we need to see the markets take a bit of a pause. And I don't think there's going to be any specific catalyst. I think really it's just you got to let the trend and the momentum kind of work itself out. I think we'll see the markets just pick up speed. People digest this news, and obviously NVIDIA will play a big role. But I think the bias is still to the upside, and it's just a bullish chart pattern unfolding.
And I want to talk about some of the places that you see opportunity here, because one of them I don't think I've talked about in quite a while. In the lithium battery sector, you've got LIT, L-I-T, the ETF here as a choice. And take me through this. You're looking for about 7.5% upside here, but we've seen EV demand soften. We're going to hear from Rivian today, though, so that narrative could quickly change. But as a lot of the tax credits expired, we saw some softer demand there, particularly for Tesla. Take me through this thesis on lithium.
Yeah, well, I mean, from a technical standpoint, looking at the charts, the money flows, the price patterns, the sentiment, if we look at all that in the lithium space, it has actually had a very nice run over the past month or so. It's created what is called a running correction, meaning it keeps grinding higher. It showed a little bit of increased volatility. It's a very explosive pattern showing that instead of pausing and trading sideways, kind of like the overall equities market may do right now, lithium just keeps grinding and pushing higher, and it's ready to pop and really expand. And we're starting to see that today. So I think it's got this momentum. I do think it's a high momentum move. And when it does pull back, it'll be very quick and sharp because it is a little bit of an unsustainable pattern longer term. But the charts are pointing to an explosive pop up about 7.5% from where we are right now. And just to touch on the news, you're right. The news in the space isn't that bullish. But investors don't trade off what is currently in the news. They're usually reacting, looking at the future going forward. So just like stocks selling off today on really good news, well, we've got kind of not the greatest news in lithium, but it's going up. The markets tend to go in the opposite direction of the short-term kind of extreme sentiment news. And really, it's usually what people aren't favorable about with the sentiment is usually what's moving up. The market tends to climb this wall of worry. And if people are worried about something, it naturally wants to go higher, kind of contrary to what people are feeling.
All right, so this may explain your next pick then here, because sentiment pretty low when it comes to real estate and housing right now. But you've got the real estate IYR here, the ETF here. You're looking for 5% upside here. Take me through that, and if there's a specific focus within real estate where you think we're going to see that upward momentum.
Yeah, IYR is a pretty broad real estate play. You know, going back, looking at the chart has had a very nice rally over the past month. It's been trading sideways, pulling back, building a bull flag pattern. And this is primed and ready for that second half of that move, another 5% move. And so the chart is really good, but we also have seasonality coming into play. This is spring, and it typically is kind of like a new beginning. It's when homes start to just flood the market. People get interested in real estate, and people move into REITs. If they can't buy a property, you know, because it may cost too much or they can't find something, they can move into an ETF like this with X amount of money. It doesn't matter how much you have, and take advantage of potentially the real estate kind of early spring bulge. And so it just naturally is on people's mind. When people don't know what to do, in terms of investments, a lot of people naturally rotate back into what they know, and that is real estate. And so we've seen that. There's been a lot of nervousness in the market over the past month. A lot of people think the recent sell-off from the Strait of Hormuz being closed down was going to lead to something bigger. And so people naturally are rotating now to real estate because they believe in it. They know it's great long-term. And so it's just a seasonality play blended with the charts are pointing to higher pricing.
All right, well, Chris, we really appreciate you being with us this morning to take a closer look at the market reaction to some of these big names and the action that we're seeing with the current backdrop that we have of volatility. Chris Vermeulen, the founder and chief investment officer over at the Technical Traders. Thanks again for being with us. And we've got a lot more for you today on Trading 360. Next, we've got the big three stocks, 3 charts, and 3 trades. Rick Ducat will take us through the technicals. Dan Deming will take us through his trades for Costco, CVS Health, and Marathon Petroleum. That's all next on Trading 360 on Schwab Network.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3 charts, 3 trades for you. Rick Ducat, of course, take us through the charts as always. Here to take us through his trades today, Dan Deming, the managing partner at KKM Financial. Dan, great to have you back on the show. Would love to kick things off with your reaction to the earnings that we got yesterday and even some big names this morning as well.
Yeah, positive overall. You know, there's been a few outliers, certainly, Meta being the big outlier this morning. But, you know, the momentum here, Marley, continues to just be very impressive given some of the headwinds that we're closing out April with. And yet the focus is on earnings, and that is driving these stocks higher and driving the market higher as it continues to digest this. What's interesting to me today, Marley, is the fact that certainly you're seeing some of those big names having good days, particularly Google today, Alphabet. But the broadening as we close out April, we're seeing that equal weight type of strength in the market here as we close out the month. And you're seeing, again, a broadening of this rally outside of just the tech names that reported this week. We're seeing, again, continued price action, higher price action in many other sectors in the market.
All right, and then let's talk about your picks today that you've brought for us here. You've got Costco as your first one. They're performing well year to date, performing well in positive territory over the last 52 weeks. Did see a couple headlines about some upset potentially over some small changes to the $1.50 hot dog meal. Yeah. But other than that, why is Costco on your big three today?
You know, I think because of the momentum it's showing, you know, it's kind of finding its footing here and starting to turn higher, and looks like it might challenge the recent highs. And we do have earnings at the end of May, and this trade example will capture that earnings announcement as it moves into June expiration. And so really today's trade example is to capture upside range and a move back towards those recent highs.
All right, Rick, so as we look at the technicals here and the setup, knowing that we have an earnings event that's about a month off, you're a little less than a month off here, what's the setup?
Range-bound, sideways drift here for this particular company. What we had was a very sharp rally off of these lows that we established shortly after the earnings that took place in December. We hit the lows, 844.06. From there, we transitioned to much more of a steeper upside move. But then we have had, as I said, a sideways grind here between about 965 to about 1028 or so. So we can see in the even shorter term, you could also draw these two converging boundary lines here, giving us more of a symmetrical triangle type shape. So these periods of lower volatility can often be a precursor to periods of higher volatility. When you do start to break out of one of these lines, the reaction can be energetic, especially if we do start to travel beyond one of these established ranges here. So when we look at our moving averages that we follow in this case, sideways consolidation again is kind of the prevailing theme here. We have our two shortest term moving averages, our 5-day and our 21-day exponential moving averages in dark blue and teal respectively, both right around the 1,000 level. We have our gold quarterly EMA down here near about 987 roughly. So that was where we had some lows recently. That remains more of a short-term supportive area to watch out for. RSI exhibits a similar triangular shape here. Not too much of a directional lean in this case, a little bit above the 50 midline, suggesting some rather slight bullishness. But once again, if we do start to break out beyond that trend line here, look for matching behavior in price and RSI to help give further confirmation to any directional moves. So now when we look at our volume profile, we can see that our node in question here, the area of heavy trading activity signified by our blue bar graph, comes in between about 970 to 1015 roughly. Furthermore, our point of control, the heaviest trading area of all, comes in at 978. So we've managed to stay above those areas here. And if we do start to get too far beyond 1015 roughly, the volume thins out very dramatically. So we could see some fast moving prices beyond that point.
All right, Dan, so as we look to trade Costco, were any of those levels that Rick just highlighted involved in your trade here?
They were, you know, above the 1,000 level, as he pointed out, as we'll continue to hold here just above that right now. And, you know, I think that, you know, if we do see this momentum and the sideways price action, if the earnings come in relatively decent, that we could see a move back into that middle of the 1,000 level. That basically the highs that we did see earlier this year. So the trade example today is really define risk because of the potential for some volatility post earnings, but also capture a move back towards the recent highs. So today's trade example is a call fly in June, buying the 1,000 strike, selling 2 of the 140 strike, and buying 1 of the 180 strike. You can do that for about $7 here, so that's really what the risk on the trade is. And it gives you the ability to capture a zone back up towards those recent highs. But then also, I think key here is defining risk, particularly this is a $1,000 stock. So again, defining that risk. If we do see some weakness, at least your risk parameters going into this trade example.
Yeah, absolutely. And Costco right now, just in the last month, trading up about 1% here, but is positive across the year and the 52-week period. Your second pick here, CVS Health, a very different chart here, although positive gains on the year.
Yeah.
Take us through CVS.
The last brick and mortar, kind of pharmacy standing, really. But I think, you just look at the general trends and the position that they have put themselves in. And again, it's a stock that has held in there well, a diversification from a lot of the tech names that get focused on. And, I'm looking at this, again, earnings next week, May 5th. Again, a potential earnings play here, but looking for this to continue to possibly move higher post earnings.
All right, Rick, as we look at the setup here for CVS Health, I can already see that we have some upward momentum here, but take us through the technicals.
Yes, a much more compelling picture than the likes of Walgreens or even Rite Aid, which have both been long ago left in the dust here. Now we can see, though, that the chart in particular that we have here is at a pretty interesting point, because from here, we had an old intraday high point. We did make an intraday high beyond that at 85.15, but that's around where we topped out again in early January, and that's around where we topped out again recently. So this level here near 84 roughly stands out as a potential breakout point here. It's resistance for now. If we do start to push above that level, it could trigger the cascade of orders that results in that kind of runaway price activity to the upside. Not saying that's going to happen. This is just a common situation that traders are often on the lookout for. To the downside, we had a gap here, 82.50. That's around where we established our lows today so far. And also here, near about 81.68 roughly, that was another high point that traders may be keeping track of. Upward sloping trend line still in play. Our white line there has been fairly consistent across several series of lows. So now we can see here as well that our moving averages in this case, we have only our 5-day in dark blue anywhere near our current price activity. That comes in near 81.50. Our teal 21-day EMA is kind of starting to get near our trend line, so that could be a confluence to watch out for if we do move too much lower. Meanwhile, RSI on the verge of crossing above that overbought area. So a push above the overbought area while price is breaking into new highs would really be a noteworthy situation. That would be what you would want to see if you were bullish in a name like this, a push into the overbought area in a trending market. So now our volume profile study once again shows that we have a pretty notable volume area here between about 76 to 80. Our point of control in this case comes in around 78. So we are holding on above that heavy trading concentration area, pushing into these, as far as this chart goes back, untested areas.
All right, and Rick, you highlighted that 84 breakout as a potential level for a breakout. We're just below that right now at 83.28. Dan, does that 84 level come into play here? Are you also looking for a breakout?
Yeah, it does. Yeah, we've been knocking on the door here a couple times, and this is the third time now, and heading into an earnings announcement. So yes, it does, and I think that if we do see that, we could see some upside price action here post earnings. And so the trade example today is a buy right. So basically buying the stock because I do think longer term it's a good hold. And writing a call above it, implied vols are elevated going into the earnings announcement. And so writing the June 90 call. So you can do that for about $1.60 here, a little higher now that the stock's trading higher. But the idea is collect about 2% versus the stock over the next 49 days. And then also have the ability to capture upside if we do see a breakout above that 84 level post earnings. So again, capturing some upside and reducing the entry cost of buying the stock.
And you do have that earnings event in there. May 6th for CVS is when they're going to report. So right in that window you've got with that going out through June. But let's take a look at your last one here. Marathon Petroleum had a really nice pop off of some of the geopolitical issues we saw in Venezuela and then in the Middle East. A bit of a pullback, and now we seem to be on the rise again here.
Yeah, and that's really what I'm looking at from a technical standpoint is the fact that, we did come off to be expected to some degree after the run that it had. But at the same time, it does appear that it's stabilized here. And to me, it looks like it could make another move above where it's currently trading. So that's the reason why I'm focused on the stock today, not only from a technical standpoint, but also from a fundamental standpoint longer term.
All right, Rick, and as we focus specifically on the technicals here, are you also seeing potential for another breakout here for Marathon?
Well, we have had a nice rally. We've had a consistent trend line here going across these lows. The reason I started this trend line here is that's about where we opened up after earnings. After earnings can often be a time to reassess your trend lines. We connected these subsequent lows. Now we're having a sharper, steeper rally that is heading into our next earnings event here. So the area around 250 to 256 roughly stands out as a potential resistance area. That would take us into some new significant highs. So kind of a similar situation to our last chart where we're close to the verge of breaking through into a new uptrend potentially here. You could also say around 228 or so. That was an old high, subsequent lows, and then a resistance point once as well. This one sticks out to the downside, as does 210 for a similar reason. Old high, high point again, and then low point after the push to the upside. So next, if we do look at our moving averages, our 5-day EMA is the one that's closest in dark blue here, 236.32. Our teal 21-day a bit below, right around 229.40 or so. RSI, you could say there was a bit of a downward sloping line, boundary line here. We could be testing that. Our green trend line to the upside is still in play, quite close to that overbought area. Once again here, that is what you would want to see if you were bullish and experiencing a breakout above those old highs. So volume profile in this case shows that we don't have a super clear singular node or spike here, kind of just a general area of higher concentration between about 220 to 240 or so. But we are, for now, holding on above that boundary. So that would be also noteworthy that we're clearing this trading concentration area. These can be consolidative areas. So if you do start to make a significant move beyond them, that usually can be more of a directional clue.
Yeah, and right now they're at 245.56 for Marathon. Dan, we also have an earnings event coming here, Marathon, on May 5th. Is that a part of the trade?
It is, and I think as we kind of approach that and just the general momentum here in this stock, that I think that there's an opportunity here. If we do see some weakness, to get long the stock, and if we continue to see upward momentum and a breakout, to participate in that. So today's trade example is a risk reversal. Now, I think maybe I might have skewed one of the strikes. I'm not sure, but I think I looked at the I'm showing 240, 250 risk reversal. It might have been a 230, 250. But at the same time, the idea here is to sell a put below the market, and if we see some weakness going in post earnings, to have the opportunity to get long the stock, and then if we continue to see upside momentum, be able to capture the upside momentum, and again with a little cash outlay, and have the ability here to again bide some time and see how this unfolds post earnings. But again, if we see some weakness, I don't mind picking up this stock below the current price level.
All right, and that price level right now about 245 and some change here, trading about 1.5% higher on the day with those earnings coming up May 5th. Dan, really appreciate you being with us today for the Big Three. Dan Deming, managing partner at KKM Financial, and of course Rick Ducat, our lead market technician, for always being here to break down the technicals. We've got a lot more for you coming up on Trading 360. Stay with us. We'll be back right after this break.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
My man. Hey!
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning Movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Schwab Coaching is concepts brought to life in the real world.
It's absolutely world-class.
We have coaches who have been in the industry and around the industry for a long time.
We have different formats because people learn differently at different times.
We have webcasts running through YouTube all day, every trading day.
We've got events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
How incredible is that? And it's free.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight Hippo Insurance. The company reported its earnings, and we have the CEO joining us amid their financial turnaround story. Joining us now, Rick McCathron, the Chief Executive Officer and President, and a member of the Board of Directors as well at Hippo Insurance. Rick, great to have you with us today. You know, as far as your earnings report, just take us through what you think some of the highlights are before I get to some of these other impressive numbers about the turnaround that you've structured here over the last year.
Yeah, no, look, first, I really appreciate being here. We're really excited about what we're accomplishing here at Hippo. When we look at how we've transformed our portfolio of insurance risks from predominantly a homeowner's insurance provider to a portfolio of very diversified exposures across multiple product lines, multiple perils, and really reducing the volatility against, our highly volatile weather-related exposures that we used to have into a more balanced exposure base and the profitability that we've been stacking up quarter after quarter. We're really, really excited that this is a continuation of our 3-year financial forecast plan that we reiterated in earnings today, that we are ahead of schedule.
And I want to walk through, you highlighted there, the weather component of your business, which coming off of this year, I mean, we had climate disasters that made homeowners insurance market basically a no-go zone for a lot of legacy carriers. Yet somehow you engineered a nearly $100 million turnaround over a 12-month period. You posted $58 million in net income for 2025. In the sector where we saw so many of your insurtech peers bleeding cash, how did you do that, Rick?
Yeah, it was an effort, certainly. over the last 3 years, we recognized to secure the viability of Hippo as a successful company, profitability had to be key to what we were accomplishing. And we made difficult decisions during that turnaround to ensure that we are driving towards profitability. We as an organization will never sacrifice profitability for growth. Fortunately, given the partnerships that we've entertained, the new products that we've offered, the new strategy that we've unveiled, we've been able to grow while improving the profitability of the business significantly. And really, the big focus is now on, we are not just a homeowners insurance provider that is incredibly subject to weather. We do write a lot of homeowners business, and we do have weather-related exposures. In the California wildfires last year, we certainly had losses. But by balancing the portfolio in a very diversified fashion, it really does mitigate and reduce volatility to those exposures.
All right, so I have a twofold follow-up to this. The first part is for the homeowners component. As far as driving profitability there, are you doing that by writing more policies or being much more selective about who you are insuring? And then what is the other component that has allowed you to diversify away from the homeowners sector and some of that exposure to weather?
Yeah, great question. And I think there's two components there. First, we are writing more business, but where we're writing that additional business, it's in areas that we had not been writing before. I'm a firm believer that it's very difficult to cut to success. The alternative approach which we've taken is, how do we actually grow to create ballast in the areas that are not as subject to weather, to create that reduced volatility across the board? You know, anything that might impact a state like California wouldn't impact a state like Florida. The exposures are very different. So as long as you're writing a ballast and a balance between multiple states and multiple product lines, you do create that more stable earning patterns. The second piece of that is by adding other product lines where we support other insurance operations, both from a carrier licensing perspective, a balance sheet perspective, a risk-taking perspective. That further diversifies away from the peril of homeowners insurance to other categories like commercial insurance, commercial casualty, liability, because typically the market cycle is opposite. When you have a very difficult, hard homeowners insurance market, the casualty market tends to be a bit more favorable. So having those levers and those toggles give us maximum flexibility to take advantage of whatever market cycle exists.
And you mentioned Florida and California specifically there. I know that coverage pricing has gone up double digits, particularly in both of those states, along some of the other more exposed states. Are you still open for business in those high-risk areas? And also, how much can we see these rates really rise before we get into a sort of crisis of mortgage eligibility in these states?
Yeah, I think first and foremost, we are very selective on our distribution partnerships and the types of exposures we go after in these particular states. We really emphasize two large channels. First, we have a strategic partnership with an organization called Westwood that is the home insurance agency for many of the new home builders in the United States. So in California, where we are writing a lot more business, we're writing newly constructed homes for that business, because newly constructed homes have less volatility, they have defensible spaces, modern building codes, fire-resistant materials. That's favorable business. The second category is of course, we've announced a strategic partnership that we have with a 1,000-pound gorilla in the space, and that is Progressive Insurance, where we are in Progressive's agency bundling Hippo home insurance offering with Progressive auto insurance in selected markets that create, again, that diversified and balanced portfolio. So those are the things that I think have really helped us grow. Your point, which I think is incredibly important, is the affordability. We're never going to get to a long-term solution where the only answer is to raise rates, because we get to a point where consumers can't afford the insurance premiums. It's incumbent upon the industry to come up with a better solution where we harden homes, where we split off certain perils and pair them with different perils, because just raising prices, it might help the insurance companies, but it doesn't help the customers. And without customers, none of us are here. So really finding a longer-term solution is what those of us that are trying to look at the insurance industry in a modern way are really, really focusing on right now.
And one of the solutions I see that you found at Hippo is this sort of shift from what you call reactive coverage to proactive protection. It looks to me like smart home devices when I was looking through some of the offerings. So how much loss ratio improvement are you seeing with installing these sensors and tech that you're putting into people's homes?
Yeah, it's significant, not just from a specific loss ratio component and improvement, but also from the types of clients that want to partner with us to help them protect their home. It's not just about home insurance. Insurance is what you have when things go wrong. It's really about holistic home protection. What can we do partnering with our customers to make sure that we are avoiding the claims from happening in the first place? The best claims experience is the claim you never have. And so if we can use smart IoT devices to do that, if we can use proactive preventative maintenance and servicing, if we go to somebody's house and identify that their hot water heater is clogged or their HVAC system has an issue that might ultimately result in a claim, we work with the customer to get that repaired or resolved prior to the claim existing.
Well, Rick, great insight. The best claim you ever have is the one you didn't file. Yes, absolutely. As someone who's had to file them, yes. Great chat there. So such a pleasure talking to you. Really appreciate you joining us today. Rick McCathron, the Chief Executive Officer and President over at Hippo Insurance. Coming up next, we've got the Disruptors. We'll be taking a closer look at Qualcomm on the rise double digits after its earnings. That's next.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
How's it going?
First day, so.
Sometimes, you know,
Next.
Try it again?
you could have done better.
Please?
Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our Disruptors. George Tillis, our senior markets correspondent, here to talk about today's company, Qualcomm, rising after earnings. Now, George, rising might be sort of a soft word to be using for a 17+% move to the upside here. What is it the street likes so much from this report?
Well, I think one of the bigger narratives that's going on is CPUs. AMD, Intel, ARM Holdings, and now Qualcomm. So Qualcomm essentially is a company that supplies the market with low-powered CPU technologies. Mainstay areas that they sell their technologies into include mobile devices, tablets, but also the automotive space and IoT, Internet of Things technologies. In fact, if you look at their handset business for the quarter, they actually declared it was down about 13%, but their licensing technology, which is CDMA based, is the majority of their sales. That was higher by 5%. But one of the highlights for the quarter was actually their automotive business. I think this is following NXPI, honestly. That stock actually had a great earnings report, and that's an automotive CPU-based company. So if you look at Qualcomm's automotive division, that increased by 38%, as well as IoT up 9%. If you look at the EPS numbers, they came in ahead of estimates, but the numbers were down relative to last year. So 265 on an EPS basis was down 7% compared to last year, and sales, which basically came in line with estimates at $10.6 billion, was down 3% year over year. And even guidance, that's what's a conundrum here with the price action so high, is guidance for next quarter came in a little bit soft, $9.6 billion on $2.2 in EPS. But nonetheless, I think the catalyst for Qualcomm, and this is why the stock is higher, is essentially the demand for CPUs. That seems to be the trend right now. Like I said, following ARM Holdings, now Qualcomm, Intel, AMD, NXPI. These are just to name a few of these companies. But At the same time, if you look at some of the prospects for Qualcomm this year, they include, of course, cloud computing technologies. So they're moving into data center and cloud. I think that's the primary catalyst that a lot of the analysts are looking at. In fact, Baird, if you look at their call, they increased their target substantively to $300 from $177. But at the same time, if you look at the EPS numbers for the next 4 quarters compared to the last 4, they're slightly down. And so I think that's why some of the analysts like JP Morgan and even Wells Fargo are remaining sector weight basis on Qualcomm with a $160 price target, even though JP Morgan did raise their target from 140 to 160.
And one thing that stuck out from the call to me, George, was the CEO commenting that it would begin shipping data center chips to what he called just a large hyperscaler within the calendar year. Wouldn't disclose the customer, says they'll say who it is, likely at their investor day in June. You know, before we get to your example trader, are you having any whispers about who that might be, or do you have any guesses?
No, I don't actually. You know, you have to think about the low-powered CPU technologies that Qualcomm supplies. So, you know, that could be anything from, you know, a handset supplier like Samsung, for instance, or it could even be a larger player in the data center space that I'm not aware of. But nonetheless, I think the price action is obviously moving first before the declared announcement in June, and of course the shipments that they're talking about are coming in Q4 of this year.
All right, so as we look to trade this name, with this move to the upside for Qualcomm today, this really nice pop of more than 17%, you know, adding to its, you know, it did put it back into positive territory for year to date because we were in the negative before this report. But last 52 weeks, up about 23% overall. How would you look to trade this name right now while we do appear to be having some upward momentum?
Yeah, there's clearly upward momentum, but you actually look at today's range, it's quite wide. The stock hit around 175 yesterday in the post market, down to 162 earlier today, and all the way back up to now 182.5. So very volatile. If you look at the chart, 182.5 is actually some resistance the stock goes back to in January. So there may be some softness in this name just because of the estimates going forward, which are still down relative to the previous year. So what I'm going to do is using the midpoint of today's candle, which is around 175, I'm basically going to sell a cash secured put that expires next Friday. So May 8th, I'm going to sell the 175 put. Altogether, I'm going to harvest, or you could harvest around $2.50 a share or $250 a contract. So the whole premise behind the trade is to hold 175 or higher by expiration next Friday, to which point that 250 premium will erode to zero. If you do structure this trade, you have to be willing and able to take ownership of stock at 175, but your cost basis is 172.5.
All right, right now we are at 182.31 for Qualcomm. George, really appreciate you taking us through that earnings report and also for the example trade there. Qualcomm trading up about 17% this morning. Coming up next, we've got our 360 round as we take a look at Meta. That's actually falling after posting an earnings beat. We'll tell you why coming up.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round to discuss Meta. Shares are lower today after the tech company topped expectations for the first quarter, but investors are wary of its raised CapEx guidance. CapEx now expected to be between $125 and $145 billion, up from a previously anticipated $115 to $135 billion. Joining us now to take a closer look at the numbers, Keith Gangle, the senior portfolio manager at Gradient Investments, and Ken Mahoney, the CEO at Mahoney Asset Management. Great to have you both with us. Keith, I'd love to start with you. Just get your thoughts on this reaction that we're seeing to the report. We're down more than 9% right now. And what really sticks out to you in terms of the numbers that we got yesterday?
Top there, it's CapEx spend. So I think the reaction to the stock being down 9% is fair. Investors weren't looking for that CapEx increase. Right now, it's a bit of an AI arms race, and Meta continues to spend, and they're guiding that 125 to 145, up $10 billion in CapEx, and investors are putting it on hold. We need to see that CapEx start flowing through to the revenue growth, and kind of that's where we are right now.
And Ken, how about you? What were some of your takeaways from the report that we got? And did you expect this move that we're seeing to the downside once we got the commentary and numbers we got yesterday afternoon?
Right. The headlines came across the tape and like, oh, it's good. It looks like a beat. And then you get underneath the hood and this is where we are. You know, I think Wall Street's had a sour thing with Zuckerberg as far as, you know, being a good steward of their money. I mean, the Megaverse and the eyewear and the tens of billions of dollars spent there are kind of wasteful. And look, there's some good there, by the way. The ad revenue year over year is one of the highest it's had in some time. Yet subscription growth is only about 3 or 4%. So we actually hit a very mature, like it's not really growing, but try to find ways to monetize it. Look, I think the market sometimes hits these stocks unfairly like here, but for good reason. I mean, CapEx, no one could tell us what the return on investment will be. And I think that's where the rubber is hitting the road, and that's where the stock is struggling today.
And Keith, I remember watching yesterday as everything was coming across the wire and seeing the free cash flow numbers and then the free cash flow guidance going forward. And Meta has typically been a free cash flow machine. So in terms of anticipating that we could see that drop off or potentially become negative over the next couple of years, how big of a shift is this going to be for investors?
Yeah, that's certainly the problem, right? With the CapEx spend, now your free cash flow for this year is supposed to be minus $4 billion. If you go back the last couple of years, they've been cash flowing, you know, tens of billions of dollars. Now we're getting to the negative territory of minus $4 billion. Forecast for next year, 2027, is for a minus $24 billion. That's an issue. When the stock worked well a couple of years ago was the year of efficiency, when Zuckerberg actually started cutting costs, focused on growing the business, and that's when it does well. So right now we're in this kind of phase of they're spending, it's an AI arms race. Where's the revenue? Once we see that and cash flow actually starts accelerating again instead of decelerating, I think that's when the stock's going to work. Now, valuation's there to support the stock. It trades at 19 times forward PE. So I think right now it's considered probably fair value with what's going on. They have a lot of positives going on, but until they can get this CapEx under control or at least show the revenue from the CapEx, I think the stock's just going to struggle right now in the near term.
And Ken, does this negative free cash flow setup break the investment case here for Meta, or is there enough tolerance with this name to wait and see if AI ultimately pays off?
Look, I think it's like going to be in quicksand for some time, and the opportunity cost of missing that left-hand lane with all the AI and the build-out and the excitement about infrastructure. So to me, I don't know, to us, we're not going to go near Meta. We would, by the way, if they changed the management, that'd be interesting, and put Zuckerberg more for visionary and let someone else make sure the trains run on time and the operations and so forth. But I don't see that happening. So there's just so many more opportunities than waiting for a turnaround here, as I mentioned, being a quicksand. And Zuckerberg just loves to spend money, but Wall Street loves to see that money being spent as an investment to have return on investment, ROI. Can you imagine that? Investors want ROI. So short term, no, I would stay away from it. It feels like a falling safe today anyway. And there's just so many more opportunities, in AI.
And Meta, in addition to that, issuing tens of billions of dollars in bonds, while of course wrapping up that spend that we're talking about. Keith, for you, does that signal that they have confidence in their future returns, or is this something that's potentially a rising financial risk for you? How are you viewing that?
I don't think it's necessarily a risk, but certainly when you go from free cash flow positive to now the last couple of years of issuing bonds, and I think this year now they're going to issue another $45 billion again to plug that hole of that negative free cash flow. that is a concern for investors. I mean, they want to go back to where it was a couple years ago when the company kicks off a lot of free cash flow, and then it's investable. And then you market multiple, instead of a 19, you can go to 20, 25 times multiple. Again, they're in the ad business. They're in the right spot. They need to spend to keep up with AI, but I think they're spending too much until we actually see some revenue generate from their spend. I think investors are going to kind of be on hold right now. And again, it's tough to be investing in this company when other companies are doing well.
And Ken, you've both raised concerns about the capital allocation and also some of the decision making. So I want to pivot back to what Keith said in his previous answer about perhaps a change in management could be due here. What would it look like if we had a Meta without Zuckerberg? And would the reaction be a greater trust in leadership or potentially catastrophic?
I would go with the former. I think it would be a net positive. This has been too many times, even early on when we first went IPO. And, Wall Street has a really good memory, a memory like an elephant, they say. And that they remember that he wouldn't give guidance and he wouldn't give sales forecasts and like kicking and screaming. And there's been a lot of not kind of great, let's say, relationship with Wall Street. And again, prove them wrong, I guess, if you would ask them. But I think at the end of the day, it's the points that we're bringing up, and investors know that just other areas. Look, we went from pretty much a growth company to Meta. Again, their subscription growth is 3 or 4% a year, 3 or 4%, between Instagram and Facebook, to maybe more of a value company. So again, if you're a value manager, you may kick the 19 forward PE, and some other numbers look kind of interesting for a value manager. But to me, this falls off the radar for a growth manager. For the return investment we're seeing, for putting that money in. And as your guest just said, this was a company that had zero debt, and now they're piling on debt. And there's this huge race to get to the finish line, and we don't know what the prize is. Is the prize just gold, beautiful thing, or is it like a little plastic thing? We don't know yet. And there are other opportunities than waiting for Facebook or Meta to address that.
All right. Well, Meta, we're seeing 9% lower on the heels of those earnings, that negative free cash flow announcement, also that increased CapEx spend. Appreciate you both being with us. Keith Gangle, Senior Portfolio Manager at Gradient Investments, and Ken Mahoney, the CEO at Mahoney Asset Management. Also want to thank all of you for being with us today on Trading 360. I'm Marley Caden. You can download our free Schwab Network app in the Apple App Store. You can also tune in 24/7 on schwabnetwork.com. I'll be back with Market on Close at 3 Eastern, 2 Central, but stay with us. Fast Market with Diane King Hall is coming up next.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab. Schwab Coaching is concepts brought to life in the real world.
Schwab Coaching is learning constantly.
It's relatable, it's practical, clear, understandable, and hopefully entertaining.
Take it for what it's worth, but I think it's absolutely world class.
Schwab Coaching is actionable, individualized, community, growth, and empowering.
It's really a human touch with your investing.
We have coaches who have been in the industry and around the industry for a long time.
So the nice thing about Schwab Coaching is that clients get access to 9 different sets of expertise.
We want to engage with you and chat on the shows we host. We want to engage with you outside of the classes we host.
A consolidation that could add to this trade. So we shall see.
We have different formats because people learn differently at different times.
If somebody's a real bookworm, we've got courses for you to learn from. They can dig in, go at their own pace.
We have webcasts running through YouTube all day, every trading day.
We've got this ongoing 24, 25 times a year events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
They're kind of helping each other learn step by step along with the education that we provide them as well.
We're going to be able to help you regardless of where you are on that path of education.
It's really unique, not just that it exists, but that you can tap into 30 some hours worth of it each and every week. How incredible is that? And it's free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. It's noon Eastern here at the New York Stock Exchange, and it's a tug of war of the latest earnings picture. You got gains in Caterpillar, that's helping to lift blue chips, while Meta is casting a cloud over the tech sector. But let's get into a check of your scorecard as we hit the lunch hour on Wall Street. The S&P 500 is better right now by 0.5%. The Dow's a bigger gain there. This is the star of the show today. The Dow rallying 1.5%. The Nasdaq 100 has flipped positive. It had been under some pressure and holding near the flat line again. You want to blame some of that resistance on the pressure on Meta. But you got Alphabet, Google as a standout today. Nasdaq 100 better by 0.25% right now. Russell 2000 has a gain of nearly the same amount on a percent basis as the Dow. It is better by 1.4% right now. Here's the roadmap for today's show. We'll look at example option strategies for Apple. It's next up at bat with earnings due after the bell among the Mag 7. Plus, the team from Likefolio will be along with new sentiment data on Roku, and over in the memory space, SanDisk is also on our radar ahead of its results. Now that we've got the roadmap for today's trading action, it's time to bring in my co-host. You've got Tom White in our Chicago studio and Kevin Hincks joining us live from the CBOE. As you know, we've got you covered from exchange to exchange and beyond. So we got big gains in the Dow thanks to Caterpillar. Meanwhile, you got that tug of war in the tech sector thanks to Alphabet, Google, Meta, etc. But Tom, I want to get just your overall big picture take when you look broad strokes across the market, across sectors, and just your general thinking.
Yeah, I think wrapping up the great month of April for equities, these are the best results since late 2020 as far as monthly gains. The S&P 500 up nearly 10% this month. The Nasdaq 100 up over 14%. Those are the best gains that we've seen in nearly 6 years. So, I think that optimism continues. If you look at the earnings that have come out, they've mostly, for the most part, according to FactSet, beaten on that higher than anticipated rate that we typically see. I think historically it's about a 75-76% beat rate. Well, we're above that. So the growth is better there on those metrics, and that's kind of lending the support. We're finally starting to see that little pullback in crude oil, down 2%, but still just below that 104 or near that $104 a barrel level at this point. So not really causing any headwinds for the equity market. I think they're relying more on the fact that, Fed didn't do anything with interest rates. You got some positive data coming out today as far as jobless claims goes. So, yeah, I think it's everybody's kind of anticipating and waiting for some type of resolution to the Middle East. That might add some volatility. But going into the month of May, right, that old adage of sell in May and go away hasn't come to fruition recently. If you look at it since 1950, the average gains in the S&P 500 up 0.3% over that period. Now, we've had Mays where the market sold off a little bit, but definitely not last year, coming off of those April lows and the year before. So, yeah, maybe getting a little bit frothy here as far as valuations go on the S&P 500 and on a technical basis with, both the S&P and NASDAQ just off all-time highs.
I love the reflection over the past month. Kevin, how do you think about the past month? Because, you look at a chart, year to date, you see that big decline in March and then this bounce back over this past month. What's your thought as we close out this month?
Yeah, it was a very ugly month of March, followed by a very incredibly positive month of April. And, you know, that is what this market was. Remember, it was a year ago we had on Liberation Day, we had a very similar action. And then the market spent the rest of the year climbing into the end of the year. Now, in terms of how we look at today, who would have thought with everything we were going to get, the most positive story would be Caterpillar today. But I guess if you spur infrastructure spending and you allow 100% depreciation of these assets, I guess it spurs a little bit of demand for large products like Caterpillar has. So, but that being said, the data today was fairly strong, in line in terms of expectations on inflation. GDP bouncing back from last quarter, up 0.5% to up 2%. We'll see if that gets even adjusted a little higher, but the data was good. The earnings are, you know, pretty solid numbers. That doesn't mean there's differentiating opinions on what exactly the stock movement is. Like Meta did what we were talking about. They upped CapEx spending, not by a lot, but you know, the market is punishing you if they think you're not being responsible with CapEx spending. Meta's talking about going to the bond market. So I think there's a lot of moving pieces trying to figure out. And here's the last thing. Crude oil is down. What does the crude oil futures market know that we haven't seen yet in any headline or any news story? So there is so many things going on in this market, it's hard to figure out exactly which one is the driving force. But all things considered, lower crude oil prices, lower dollar, lower yields, lower VIX. Market looks like it's risk on. You've got gold up, you've got Bitcoin up. This looks like a risk on market despite crude oil and its recent rally. So, yeah, nothing short of incredible. So many stories, hard to get them in one show, Diane.
Yeah, it's a lot of moving parts. Well, let's get into one of those moving parts. That's big tech. They're planning to spend big, as you mentioned, Kevin, this year. The biggest U.S. tech firms now expected, when you add it all up, to pour as much as $725 billion into CapEx this year. There is divergence, obviously, in reaction to the numbers. Tom, we'll start with you. I know you're very much across Alphabet, Google. That's been a strong performer today. And, of course, I know you're across Microsoft. Let's talk Alphabet, Google first.
Yeah, you look at the numbers, you know, everybody's kind of focused in immediately on that CapEx number where they raised that to $180 to $190 billion. That's up from $175 to $185 billion. But when you've got results the way that they came out, as far as growth numbers go, cloud 63% growth rate, far above expectations. Are they taking market share? That's the question. Advertising revenue up 15% year over year. That was better than expected by a few percentage points. You look at, they've nearly doubled EPS estimates, 511, versus about 267, with what they had anticipated at this point. And then revenue came in up 22%. I mean, it was nearly $3 billion more than the street anticipated and higher than most of the whisper numbers. They're going to start selling their TPUs, Waymo, 500,000 rides a week. And then you start looking at Gemini. Enterprise paid active users grew by 40% quarter over quarter. So it seems like all those, silos of revenue generation are all firing on the same cylinder right now, and they're doing really well. And that's not surprising. But then you look at Microsoft. Well, they said that they're raising CapEx spend too, and the stock's getting hit a little bit on that news. Now, initially, when the earnings came out on Microsoft, the stock popped because it was a pretty good report, and maybe still in the penalty box at this point, just due to the SaaS apocalypse and maybe some threats to their enterprise side of their business at this point. But they had good growth rates also, but the stock a little bit lackluster, down about 4 or 5% today. Not surprising, still down in bear market territory at this point. But yeah, I think the standout and setting the tone here is Alphabet's report, just because of the growth numbers and the expectations that they're still going to continue to raise estimates moving forward. Microsoft's got some work to do, but I don't think that was a bad report by any stretch of the imagination.
Yeah, that's what I was going to say, Tom, real quick. Do you feel like this reaction to Microsoft is fair? Because, it was choppy in the pre-market, and after the close, as you mentioned, different reaction. Do you feel like this is fair?
Probably not, but I think maybe people pouring money maybe out of Microsoft with, hey, that their growth rate isn't as strong. I mean, cloud grew 40%. I mean, that's a good pace that they had. They grew the Copilot seats up 33% from 15 million to 20 million. They expect that to go up again in the September quarter. So there were good parts of this. I just think that maybe investors just don't feel like the overall growth trajectory for Microsoft is as good of an outlook as some of the other names. I know we've seen a bunch of price target cuts over the last month or two in Microsoft, but I saw some price target hikes today too from the sell side. So maybe a little washout needed before maybe people start getting back into this name, because if you look at it on a valuation basis compared to some of its competitors in the Mag 7 and the other major tech companies, it's getting pretty low considering their growth rate.
All right, let's talk Amazon, Kevin. So it's interesting. This one has had a choppy reaction too. Initially there was some pressure after its results. Then it was turning higher after the earnings call this morning, and the pre-market was indicated higher. The reaction today for Amazon, it feels like you're trying to read through the pluses and minuses here. A lot of analysts are raising their price targets. What's your take on Amazon?
This is one of those, they may have sold the news, bought the rally up, bought the rumor up into the number. The stock has rallied. It was almost at all-time highs, as you know, but the numbers they put up, earnings per share, such an incredible beat by over $1. Revenue, $181.5 billion. That's 17% with something as big as Amazon. Andy Jassy did come out and justify more CapEx spending. He said they're going to keep investing. I still think that's what's weighing on the stock. That made people take profits. It was because of Amazon. But advertising, retail, all doing well. Guidance, they said net sales 194 to 199 billion. That's 16% growth year over year. They're just putting up monster numbers. But like I said, just like it started out with Tesla and it's filtered into these names, this CapEx, this is what's causing concern in these markets right now. And so the fact that all these names, Microsoft had run $75 into its earnings. So some profit taking here, some disappointment in the earnings is probably what's happening right now. I'm not surprised. I think Microsoft and Amazon are down but had pretty solid earnings events, but you can't talk about increasing CapEx right now. You saw the same thing from Meta Platforms. They upped it $10 billion to $125 to $145. They may, like I said before, they're going to have to go in the debt market and raise $25 billion. But they're putting up big numbers. The revenue numbers are all there. Advertising is strong. These companies are all putting up big numbers, but like Wall Street tends to do, they get stuck on one thing, and that is they want more responsible CapEx spending because they're worried that you may not be able to eventually monetize it and become profitable. Andy Jassy claims, no, we're not doing this. We see that we're going to be profitable doing this. He really defended their CapEx spending. Stock not acting like this, but remember, the thing is, when you're dealing with all the names, other than Google Alphabet that just annihilated their numbers, all these other stocks had run pretty strong up into this earnings report. So a little softness here shouldn't really, make you worry about these names. They're all doing extremely well.
Okay, let's talk. Tom, I want to get your take on oil, right? We're pulling back right now, but we're still elevated. We're sitting above $104 a barrel. Gas prices are high. I was driving past the gas station yesterday. I was like, oh my gosh, yikes. The national average today is sitting at $4.30. We're at the highest level since 2022. So again, these oil prices still elevated. How do you read through the tea leaves on this?
Well, I think, the market for the most part, as I mentioned, the equity market at or near all-time highs just off of those levels at this point. They've kind of ignored the fact that crude oil is up at these levels. I don't know if that's a good idea. The impact from higher oil and energy costs have been pulled back, right? Since, the 90s when there were, energy shocks in the 80s, 70s, 80s, 90s that really took a toll on equity markets. Now we're kind of pushing those aside because it's not that big of a headwind at this point. Now GDP grew at 2%, right? A little bit below estimates of about 2.2% for this first read. But at the same time, we're still growing even in the face of this rising inflation due to energy shocks. Axios yesterday said that CENTCOM set to potential more military action coming soon. The blockade's still in effect. I'm guessing somebody said they turned back 42 to 44 ships so far at this point. And this is all based on the nuclear deal. And Trump stated yesterday he's not happy with the proposals that they got from Iran. And that's probably going to escalate what's going on over there in the Middle East. And that's going to be a concern. I just think if you take a look at it, we're doing this on our own with Israel. At some point, Diane and Kev, I think these other countries are going to have to get involved because they're the ones struggling more and more as far as the inflationary pressures that are coming out of them paying more for fuel, whether it's China, whether it's Southeast Asia, whether it's India, and especially the EU. They've got to get involved a little bit. You got to get that Strait of Hormuz open, and that just doesn't look like it's going to be in the cards in the near term at least.
Yeah, interesting. And listen, what I think too, as you talk about that, is we may see some trends in EVs as a result of that. This may end up boding well for Tesla and obviously other EV makers. Great points on the numbers on the economic data: 3.2% for core inflation. The economy growing 2%, a little lighter than expected, but there's growth. All right, we got bull versus bear coming up. The guys will get their example trades put together for Apple. It's next on deck to release this quarterly.
Okay, so the giveaway, nobody's here, so we'll go ahead and close out today's stream. Hope you all have a great Friday. This would be it for me. Fridays are out as I am working my other jobs. Anyways, which I need to go to that schedule, make sure that's not scheduled. Yeah, that'll be it for today. Let me see, is there anybody to rate out to? I don't believe so, but we'll find out. Yeah, one viewer. Start the rate of these guys. Right now. Okay, we're rating out to Tradeify TV.
Firing the CEO is the stuff.
Looks like they've got active live traders there, so kind of interesting. I've been looking at them for a little bit, so it looks pretty good. I like their channel. Anyways, peace out.
This is Sugar Space, y'all. We got lots of music,